Chartered Accountants, members of ICAI. It is a privilege to stand here and welcome you all to this special session, a session on direct and indirect taxation. Well,
Auditing standards.
it is a privilege to welcome you all to this session. Well, if you hold flowers in your hands for a little longer, your hands start smelling like flowers. If you spend a lot of time playing with kids, you start mimicking the kids and behave like kids. And that is why it is important to spend time on these seminars, because spending time with these masters of experienced chartered accountants, we start behaving like them and updating ourselves on the current trends. On that note, thank you all for being here. I request the chairman, CA Pramod, to escort the speaker, CA Jaideep, on stage. It is a privilege to have you both here on stage, sir. I request the chairman, CA Pramod, to give the welcome address.
Good evening, my dear members. Of course, if it's a topic on audit, none of us here are prepared. I mean, if it's a topic on taxes, but it's a group audit engagement. The reason of designing this seminar was keeping the specific interest of our profession and SMPs. Most of the time, if you look at the complexities and layers, today's business layers are expanded because of due to whatever reasons of structuring in place. And as a group auditor, most of us have handled the engagements, and what are the reporting perspectives involved? Also, what is that we need to do as an auditor? First thing first, I would like to ask everyone, I wouldn't want to ask on a public forum, at least on a introspective mode. The standard requires us to send out the referral instructions, though not wordingly says that so. Have we communicated with our component auditors? Basically, that's the essence. And have we identified our own risks? What is supposed to be involved in that subsidy? Did we even look into that? What are the risks? What needs to be identified at subsidy level? And have we communicated to those auditors that these are the risks which you need to take care, or these are the account balances which you are more concerned as a group auditor, and how do you tackle this? Whether any specific audit procedures is what you have demonstrated them to do, or you have left it to at their discretion. And have you also looked into what is your materiality for your consolidation purposes, and have you communicated those things to the auditor as well? So under this context, referral instructions becomes very critical for us to communicate to do so. And most of the time I think most of us are aware of the big debate which is going on about this ISA 600, which is a long topic with discussion which is going on. And ISA 600, SA 600, the fundamental difference is, my responsibilities on the component audits, am I liable for the audit work papers also? The fundamental debate is that. But without that being in place, as long as we feel that we are a member of ICAI, we could have probably taken on a lighter note, and we could have relied on the financial information of those what is being reported to us. But did we even evaluate whether the competency of the auditor, of course, what about the firm, what about the firm size, whether is he capable to enough handle that firm of that size? Have we even looked into that? Evaluation in our documentation also plays a critical role. So in this context, be it a component which you are supposed to consolidate, let it be outside or a domestic subsidiaries, these things are mandatory as part of our auditing standards. So that's the essence. We thought that we will keep this half-day seminar just to reiterate those information and what are our roles and responsibility. Also, I have requested the speakers to look into the reporting perspectives also. Let's say most of the time we have a subsidiary audited by a different auditor, at that point of time, is just another matter sufficient to say that you are not audited? What if that subsidiary itself is a material? Have you given an adequate qualification when you are not auditing it? And how did you get the comfort to give a true and fair opinion on the consolidated financial statements? With these thoughts in your mind, I would like to open this session to the renowned speakers here. I am thankful that CA Rajesh and Jaideep immediately agreed when we designed this today's seminar. With this, I welcome you all. Have a happy learning. Thank you.
Thank you, sir. The lighting of a lamp, often referred to as diya or deepam, is a significant ritual in our culture, especially before the commencement of any auspicious event or program. This holds deep religious and cultural significance, symbolizing knowledge, enlightenment, and the dispelling of darkness. I welcome our chairman, CA Pramod Hegde, and our esteemed speakers, CA Rajesh and CA Jaideep, for lighting the lamp. We would like to introduce our esteemed speakers of the day before we light the lamp. I take immense pleasure in introducing our esteemed speaker, CA Rajesh. He is a partner with the assurance function of a large accounting firm and has extensive experience of 25 years covering leading assurance engagement with a Big Four firm that covers diverse fields like statutory audits, ICFR, Ind-AS, IPOs, and earnouts. He has led engagements for major listed entities, mid-sized enterprises, and PE-invested entities in India, UK, UAE, and US. He has had the opportunity to work across a diverse industry sector covering technology, e-commerce, healthcare, and various other diverse sectors. He is keenly interested in audit quality matters and has actively contributed on file reviews, training, and talent development. Rajesh speaks on standards on auditing, Ind-AS, IFRS, and internal controls. We welcome you, sir.
It is also an immense pleasure to welcome the speaker, CA Jaideep, here with us. CA Jaideep is an associate member of ICI and a graduate of business management. CA Jaideep has more than 20 years of experience working with one of the largest professional services firm, where he also served as an audit partner before venturing out to an entrepreneurial journey 2 years ago with an intent to provide audit quality as a service to audit firms. His past experiences include audit across various industrial sectors, namely manufacturing, engineering, food processing, consumer durables, and others. CA Jaideep has experience in performing equity listing engagement, specially agreed upon procedures, and other transaction-related due diligence services for large Indian and multinational companies, in addition to financial statement audits. Well, he has more than 50 years of being an actively involved person in various quality initiatives covering engagement files, reviewing for compliance with professional standards, consulting to engagement terms with regard to sufficiency of planned audit procedures, to address specific risks, and consultation to engagement teams on proposed audit report modifications and basis for such conclusions, etc. He also has more than 20 years of experience in conducting technical and soft skill training for professionals. It is a pleasure to have you here, sir. Thank you so much. Now, we insist all the guests on the dais to light the lamp. I request all the members to please stand, raise for the motto song of ICAI.
यैषस्सुप्तेषु जाग्रति यैषस्सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमानः निर्विमानः तदेव शुक्लं तदेव शुक्लं
With immense delight and pleasure, I request CA Jaideep to the dais.
Today's session we are splitting into kind of three sub-sections. First one is on understanding SA 600 as it stands, which is what I'll be covering. We'll have a short tea break after that, post which implementation considerations as to how the standard actually has to be implemented. What are the implement considerations that come in considering the circular that NFRA issued, including the fact that there are proposed indices that are going to come out effective for 1st April if the ministry signs off on it of 2026, which is going to be in line with the ISA. So what are the key variation differences that would come in? How would the current SA 600 stand against the proposed indices will be the second session. Towards the end, we'll kind of have a panel, have a few questions that I will get my colleague Rajesh to respond on, and then open it out to all of you to also ask questions, and we'll take it from there. As of course, as auditors, we give the disclaimer, and some of the sessions where I attended, the NFRA chair very clearly used to make these disclaimers, and he said, that's one thing as a DOM CA he's learned from all his interactions with the auditors as part of his inspections that they've carried out, and that is to give a disclaimer before he starts anything. So I decided I should also do the same thing, being a chartered accountant myself, that I should start something with a disclaimer. So the first disclaimer I'm going to say is everything we're going to speak here is going to be our personal thoughts. It's nothing to do with the institute or any of the opinions of the office bearers.
Personal, nothing personal, professional.
Huh?
Personal, nothing professional.
Yes. So first we start with understanding the key requirements of the standard. Coincidentally, in 2009, all the auditing standards underwent a change, mainly to bring it in line with the international standards that were existing at that point of time. And therefore, if you look at most of the standards, they say effective from 1st April 2010. It was only SA 600 that didn't undergo any changes, and at that point of time, SA 299 also. But then SA 299 underwent a change in 2018 to bring certain other additions to it. Because SA 299 and joint audits, coincidentally, is something that's very specific to India. It's not there in international. It's something that's specific to, say, France. I think Pakistan also has it, and a few other countries which have mandated joint audits have put in a standard. Otherwise, the international standard per se doesn't cover it. SA 600, where it applies, is it's categorized as two types of auditors. One is known as the principal auditor, and one is known as the other auditor. What, as you start speaking, is talking about what we refer to as component auditors. That is the auditor auditing various components. And the word used is components here because a component can be a branch, it can be a division, it can be a subsidiary, it can be a joint venture, it can be an associate. Now, what do we mean when we say branches and divisions? Best example of branches is very clear. We are looking at other entities. If you take something like a bank, they have branches all over the place. We have separate auditors, so those would become components. Similarly, if I have to take an example, something like ITC Limited, they have, as a company, they have one division which does tobacco, one division which manages hotels, one division which manages ready-to-eat items. They are by individual different transactions, different businesses, but they all get consolidated under one company. And again, operationally they are spread across the country. Each one is managed by a different CEO, different CFO, and they all report into the group CEO and group CFO that is sitting in one company. So there it becomes divisions. So there again, it might be something that falls under a group audit. So these are the different categories under which it comes in. Having categorized it as something that comes as a group audit, you need to evaluate whether this engagement requires you or you are capable of doing the entire audit on your own. In which case, SA 600 would not apply to you, even though it is categorized as a group engagement. Or are you relying on the work carried out by another auditor, and therefore, if you are doing so, that other auditor will be called as the other auditor under the standard, and the requirements of SA 600 would then apply to you. Again, this doesn't apply in case of joint audits. Only in India, globally this standard covers joint audits as much as it does group audits, but for Indian purposes we have a separate standard, and therefore this specifically would not cover it. Now when you start looking at what are the responsibilities of a principal auditor. Now para 9 of SA 600 covers the heading saying acceptance as principal auditor. Now when you start looking at the conditions that paragraph 9 covers, conceptually, those are the conditions you have to evaluate before you decide to accept this engagement as an auditor. Now, under SQC1, the very first parameter or principle that you need to comply under SQC1 is client and engagement acceptance. Now, SQC requires that you evaluate the risks involved on the client. You're supposed to evaluate the risks involved on the engagement, and only if you have safeguards to address those risks, you're supposed to accept the engagement as an auditor. Now, when the engagement is a group audit, SA 600 covers certain categories you need to evaluate before you agree to become the principal auditor. If you don't have safeguards for these risks, logically you should not accept the auditor audit. The first one is, and I think Pramod mentioned it earlier when we were speaking about the materiality of the portion of the financial information which the principal auditor is auditing. Which means when I'm looking at either the standalone, if the group is at a branch or division level, or the consolidated financials, if the components are subsidiaries, joint ventures and associates, if the share of the parent where you are directly responsible is not material enough to actually give you satisfaction on signing off on the consolidated numbers, you have to evaluate what your safeguards are, and you should have proper plans to respond to that risk before you accept the audit. I will perhaps not jump right onto what Pawan mentioned earlier, saying, if your not coverage is not enough, should you qualify your accounts in the first place, or just rely on the auditor, is a matter I will discuss a little later in the slides. But here the first evaluation is, A, what is the extent of coverage that is happening? Significantly, this means that your coverage as an auditor, though the standard does not specify, in my experience, practically what one looks at is direct coverage should happen at least for 50% minimum, if not more. If I look at the larger firms, their condition is 70%. Some of them have 75%. If your coverage is less than that, you don't even accept the audit. That coverage could be direct coverage of the parent and certain subsidiaries, not all, certain subsidiaries, such that the coverage on consolidated basis is at least, in the large firms, 75%. I think since there is no condition criteria given here, we should at least ensure more than 50%. That being said, of course, there are certain points, SEBI's guidance, I think the NFR in the circle also refer to it, talking about the responsibilities that where you are the auditor for the consolidated accounts, you should at the minimum do limited review of all the entities being covered where you are not the auditor. I'll let Rajesh cover some aspects of that, and certain elements of that I'll also cover as it comes under para 9, and we discuss on that, saying what's the extent of coverage and how do you work out your roles and responsibilities as a principal auditor. The second item is degree of knowledge regarding business of the component, which means when you are doing your evaluation as part of the engagement acceptance principle, you should have sufficient documentation in your file or the basis in which you accepted this engagement as to how much of the component's business are you aware of. Which means, again, the standard says if you feel as a principal auditor that it's necessary to visit the component, you should visit the component. Similarly, under section 143, if you look at it, as the auditor of the parent entity, the Companies Act gives you complete rights over the books of accounts of the component. Now, at any point of time, there is no restriction for you to visit any of the subsidiaries. The parent company cannot say that you are not the auditor of the subsidiary, therefore you can't visit it. Again, Companies Act gives you those rights. So there should be sufficient documentation assessment within your file which demonstrates that you have sufficient knowledge of the business or what the component is into. So you cannot say the audit of the component is being done by another auditor. I find the other auditor is, a member of the institute and relying on their work and therefore nothing else I've done further. That cannot be the case. The current SA 600 clearly requires that even just for accepting the audit engagement on your role as principal auditor, you should have sufficient documentation to demonstrate your understanding of those components. Now here, of course, I'm not talking about in one component. If there are 10 subsidiaries, the role of what each subsidiary is, the business that they are into, what are the key elements, all of that should be in your files. Now this also comes out saying the risk of material misstatements in the financial information of the components that are being audited by the other auditor. Now, there is a separate standard. Now, here the key thing that I'm trying to highlight is what I also spoke on the first slide. All the other auditing standards underwent a change in 2009 with an effective date of 2010, except for SA 600. Now, those changes in the other standards have increased the roles and responsibilities of an auditor. SA 200 underwent a change. Now, where the objectives of an audit are clearly highlighted. Now, if you start looking at that, SA 315 underwent a change, where the risk of material misstatement is carried out as part of your audit, the identification and determination. That underwent a change in SA 315. The indices that are being proposed, further focus is being placed on certain elements of risk identification and determination. SA 240 underwent a change as far as determination of fraud considerations are there on an audit. Now with all these changes happening in those auditing standards, with nothing being changed in SA 600, when I come down and look at the risk of material misstatement having been done at a component level, looking at those other standards, it means A, you identified what can possibly go wrong in each of every account line item at the components. You identified whether that what can go wrong risk is material or not. Again, the risk of material misstatement consists of two elements: inherent risk, control risk, as defined under SA 200. If I get down to SA 315, it requires you to evaluate the likelihood and magnitude of something going wrong in determining the extent of the risk. So this you should have done for all account balances, cost of transactions, disclosures of each component in determining which are all the possible risks that exist. That extent of knowledge should be there with the principal auditor. Which means your audit planning memorandum documentation. I'm not sure how many of you have gone through the templates of working papers that was issued by the institute sometime in June 2023. I think on 29th or 30th June, the institute issued a guidance note, it's like a guidance note, on work paper templates, providing formats and templates in which all auditors should maintain at minimum the formats and all their requirements under the standards. It shows the format for audit planning memo, it shows the formats for discussions with engagement team members, the format for client, all of that is covered. Basically, each template on the various auditing standards that should demonstrate the documentation requirements under the standard, templates have been provided. Now, there's a template there for auditing planning memorandum as well, and that audit plan memo, in line with the requirements of this SA 600, would also require to cover the implications and plans associated with the components. The fourth, as I mentioned earlier, you will need to examine whether you need to exercise your rights under the Companies Act of being able to visit the component, go through the books of the component to actually be able to determine what can go wrong and what the risks would be. The fourth element that comes in here is, you need to figure out whether any additional procedures are required as the principal auditor to be carried out for the component. Now, in order to be able to do this, it conceptually means that A, you have identified and evaluated the sufficiency of work being done by that component or other auditor, and determine whether any further audit procedures need to be carried out by you as principal auditor. Rajesh, I think, will be covering a little more detail on what these evaluations, interactions with the component auditor should be for you to come to this conclusion. But your work paper should also demonstrate how have you demonstrated significant participation with the work of the component auditor. So all of these need to come in, and only if there is sufficient safeguards, plans to address all these 4 points, can you even accept your role as a principal auditor. Otherwise, you should have rejected the appointment as an auditor. Now let's look at what procedures are required as a principal auditor and what you go about planning, especially when you choose to rely on the work of the other auditor. If you decide to go ahead and do additional procedures or do the audit directly on your own, irrespective of other auditor existing, these requirements don't apply. Only if you plan to rely on their work, these will come in. First one is to evaluate the professional competence. I think Pramod did draw a reference to it when you look at professional competence. The paragraph in the standard says you have to evaluate professional, you should, the word used is should, evaluate the professional competence, except if the person is a member of the institute. So if the person is not a member of the institute, then there should be additional evaluations that you need to carry out, you should carry out, to confirm whether I can even rely on the work of that person. But if you look at the way it's drafted, the paragraph in the standard, it does not say that just because a person is a member of the institute, you need not do anything. That's not what the section is saying. The section is saying you should mandatorily evaluate the competence of the person if they are not a member of the institute. If he is a member of the institute, it's not mandatory, but you need to still evaluate whether I need something or not. For example, if the component auditor is a very large firm, been existing for say 100 years, already well known in the industry, you may say, I do not need to further evaluate the competence. However, this firm was formed just last year. The partner is somebody who qualified just 2 years ago. Now, when I look at the evaluation of competence, you need to apply your professional judgment. Do I need to evaluate this person, though he's a member of the institute? That evaluation is an element of professional judgment from you as principal auditor. And there is a specific auditing standard which requires that all elements of significant judgment should be documented. And therefore, you should have a document in your file as to why did you not do any further evaluation and just relied on the fact that this person is a member of the institute. That requirement also will come in. And I think, our chairman did mention a little earlier when he said, do you just rely on the fact that its competency is as a member of the institute? Or do I look at the capability? What's the size, operations of the firm? I'll not dwell on this too much. I think when we get into the practical implementation of the standard, I think Rajesh should give us some insights on what all one needs to look at when you're evaluating the professional competence of a component auditor. The next thing you need to do is evaluate whether the work done by the component auditor provides appropriate audit evidence. Now, evaluation whether the evidence given to you, and again, I am highlighting this because the responsibility on the consolidated financial statements or the standalone, if you are relying on branch auditors and other auditors for the divisions, is that of that engagement partner who is finally putting his or her name on that audit report and financial statements. The fact that you called out something in the other matters paragraph is irrelevant. It is finally your name on the letterhead, your name on the signature, your name on the financial statements. So for all practical purposes, the shareholders are relying on that name. And therefore, it is at your responsibility to apply judgment to evaluate whether that work done by the component or other auditor is sufficient for you to put your name on the financials. And only if it is sufficient, you will go ahead and put your name. If not, you will do whatever extra you feel is necessary. If so, for you to get the comfort. And those is what we call as additional procedures. Now, the key thing is, paragraph 12 in SA 600 says that the principal auditor should perform procedures to obtain sufficient appropriate audit evidence. Now, when you talk about what is sufficient appropriate audit evidence, again under SS 200 it is defined. It is, I don't know the exact wordings, but it should provide you more than convincing evidence. It's called sufficient. Now, what could convince you that sufficient evidence is available to substantiate the inclusion of those numbers into the consolidated numbers cannot just be the fact that, okay, I took a audit report. That cannot be convincing. So there has to be additional work and documentation around how did you convince yourself that the work was sufficient. And when using the work of another auditor, the principal auditor should ordinarily perform following procedures. Now we'll look at what those procedures are. But the key thing that you should focus here is, and in two places the word used is should. Which means it's not an optional procedure or step to be carried out, it's a mandatory step to be carried out. Otherwise they would have said the auditor, principal auditor may. But the moment you say may, it's an element of applying your judgment as to whether I should or shouldn't. But when you say should, there is no element of judgment. You have to do it. The moment you say you have to do it, there should be work paper documentation in file demonstrating that you actually did this. It cannot be, a year later, 2 years later saying, no, actually I did this, but I forgot to put it down in writing. Because the principles of audit is, if it has not been documented, it has not been done. You cannot argue saying it was done, it is there in my mind, but I forgot to write it down. No. The standard on audit documentation is very clear. Anything and everything associated with the audit that you have carried out should be documented and maintained in your audit file. So what are these procedures? I think Pramod mentioned it a little earlier as part of his briefing as to why this seminar is being done. Where he said, do we actually interact with the component or the other auditor? So if you look at what one of the responsibilities of what you should be doing as a principal auditor is advise the other auditor. Now, the moment you say you should be advising the auditor, that means there should be a communication. Standard does not specify the form of communication. But there should be evidence of you having communicated with the other auditor. Communication should be that you intend to rely on their work. Okay, so that communication should be made. It cannot be presumed that just because that person is giving an audit report and you are calling it out in your audit report saying you relied on the work. No. There should be a communication from you to them that you intend to rely. Otherwise, conceptually, the other auditor is not aware that you plan to use their audit report. Okay, because there are two elements to this. At what point of time there's a financial statement, I'm slightly digressing. There's an element of audit report date, there's an element of release date that happens. You must sign your financial statement on a certain date. The release of the financial statements happen on a certain date. Why are these dates important? This is drawn reference to the auditing standard on subsequent events. As to till what point of time an auditor is responsible for the subsequent events. So there identifying a report date and release date becomes important. So the moment these financial statements get provided to the parent auditor for consolidation, conceptually they get released, even if it's a private company. Otherwise, for practical purposes, the release date is the AGM date or the circular for the AGM when it goes up, because that's when it's released to the public. Otherwise, till then it's only remaining with the board members. But here, the moment it goes out to the parent company's auditors, as good as being released to public outside of the board. And therefore, there could be a little evaluation. Do you have responsibilities to look at anything that's happened from your report date to the time it's gone to the principal auditor and subsequent events to inform them of the subsequent events. So that's out of course outside the scope of SA 600, but that's under another auditing standard. The principal auditor would inform the other auditor of matters such as areas requiring special consideration. Now, we already spoke in paragraph 9 earlier that as a principal auditor, in addition to having understanding of the component's business, you will also identify the risks associated with the component. Here again, that means you should have communicated those risks to the other auditor. Which means whether the other auditor has identified same risks or not, you should communicate the risks you have identified. If they have also identified the same risks, no problem, they can proceed. If they have not, they have to factor in the risks you have communicated to them and they carry out their audits. And why should they factor those risks communicated by you? Because you have intimated to them that you intend to rely on their work. Because you have made that communication of your intention to rely, you now have to factor the risks that you have communicated. Now both these cases, it says communication of intent and communication of risks identified. Now the standard does not call out and say you should issue referral instructions, but indirectly this is talking about the need for you to give a communication in some form, which in ISA 600 when it got amended was further refined to call it out as referral instructions, including what all should be included in those instructions. So logically, if you look at, irrespective of how the arguments go, saying the ISA 600 is good enough, we don't need ISA 600 here and there. ISA 600 by itself actually asks for all of this. The difference I note between this and the revised ISA that came in later on, and the revised ISA that underwent a change again last year, the revisions were only to further identify and provide clarification on what the previous standard was already asking you to do. For example, here it says advise the other auditor, communicate the areas of requiring special consideration. It's a little vague. The revision that happened was to explain how should you be doing this. And therefore it's not a deviation or add-on to the standard, it's clarification on the existing standard. So it goes on to say you can communicate this through in the form of referral instructions. You will include all elements of significant risks having higher consideration. You will put, so that is covering the second portion. You will communicate particulars of related parties to them, which is actually required under the auditing standard when you look at related parties and on fraud, that the communication should be made to the competent auditor of these elements. So the revisions are only providing further guidance and clarifications. It's not really adding more responsibilities. Advise the auditor on significant accounting, auditing, reporting requirements and obtain a representation on compliance. Now, this is under a category of what you should do as a principal auditor. So point B, you're saying you have to advise them on significant accounting matters, which means there is a requirement that when you are doing consolidation, all the components should be, and this is under Ind AS or AS, not under auditing standard, that all those components should be under the same accounting policies as the parent. Which means if you have a parent which is under, say, Ind AS, but you have a component which is sitting, say, in the Philippines, principally their accounting standards are different, your Ind AS is different, you may need to communicate to that auditor saying it's under these standards, these are the key differences. Please ensure that these are compliant because this is the parent entity's accounting policies. Key reasons of the difference, why? Because for example, investment properties. Ind AS says it has to be on cost basis. But if Philippines is following IFRS permits you both fair value as well as cost. So you have to communicate to the auditor saying even though they are compliant with IFRS, please note parent entity's policy is cost. So if there is a not following cost, make sure adjusting entries are posted, otherwise I cannot consider it for consolidation. So that communication should happen because first paragraph says you have to make that communication. And second paragraph requires you to tell them the difference in the accounting policies. Again, auditing and reporting requirements. Not everybody may have, reporting or globally required reporting on controls. Some of them may not have, elements of fraud reporting that might be there. So if you need specific reporting on fraud, you may want to understand whether there is any elements of fraud identified in the component that has happened, which could result from involvement of the parent, in which case you may then have a 143.12 reporting at the parent level. So for you to understand that, you may need information from the component auditor. And therefore, you may want to brief them on those elements as well. So all of this has to be now, logically all this can't be in the oral form because at the end of the day, auditing standard requires an audit documentation that all these kind of communications be documented to demonstrate you actually performed these tasks. Why? Because the heading says you should be doing this. So the only way for you to demonstrate all of this is actually officially issue referral instructions. And therefore, it's not that the current standard doesn't require you to issue it. It's a requirement of the international standards. No, even the current standard actually is asking you to issue referral instructions without, as Pramod said earlier, using the words referral instruction. Now, here the only difference is the word used is might. The principal auditor might discuss with the other auditor the procedures applied, or you may choose to review a written summary of the other auditor's procedures. Now, if you look at the way it is put in, it is one of the two. It's not saying you have to do two, but you have to do one of them. So I agree. We've had a lot of concerns on work paper sharing, not sharing, and we'll discuss that a little later in the second session. But if not work papers, you're supposed to provide us written submission of the procedures carried out, the findings that are there, and provide a written summary. Or if the principal auditor provides a questionnaire, the competent auditor fills up that questionnaire and provides their findings against that questionnaire. So they need not share their work papers, but they'll share this separate information. So when I again look at this and it says, you can provide a questionnaire, then we have to give you a completed questionnaire. How are you communicating this questionnaire? Again, it goes back indirectly. We are talking about a referral instruction again. So the standard may not be using that term, but you'll find that wherever these discussions come in, indirectly they're all looking at a single form of communication, which is nothing but the referral instructions. So if you have to look at it in more detail, I just highlighted some key terms within this paragraph. Now, one is, of course, you said you might discuss, which means it's not mandating that you have to have a discussion with the other auditor. But you may have to get a written communication of the procedures that they have carried out. When you say procedures carried out, it roughly translates down to you should be aware of the component or other auditors' audit programs. You may not look at their work paper where they documented their testing, but you should know what audit program did they follow. Because you might have, say, 10 procedures you carried out. The other auditors have only 8 procedures, in which case you may want to inform them that there are 2 additional procedures I want you to carry out and you're doing that audit. So for you to be able to communicate that to them, you should have a fair understanding received from them as to what procedures they are planning to carry out. You may wish to visit the other auditor. Again, the word used is may, so it's not mandating that you have to go to the other auditor and you have to meet them, discuss with them. But again, when the standard gives you a choice, and therefore you exercise, and I use the word again, professional judgment as to whether you should or should not, because the words used is may. Your documentation should come in as to why you chose not to visit the competent auditor. It could be you have worked with this competent auditor before, maybe he was working in your firm earlier before he or she started their own practice. That person is a competent auditor, so you know them well aware. You have received everything in writing from them in the form of communications as to what they have done, what their conclusions are, and therefore you felt not necessary to go down and visit them. Fine. So you'll write that down, keep it in your file, as in this is the reason I am not visited this person. If not, again, it may give an appearance you have not exercised professional judgment in arriving at a decision as to why you chose to visit or not visit. The nature, timing, and extent of procedures will depend on circumstances of the engagement. And again, I have highlighted what is important. Principal auditor's knowledge of the professional competence. So, if you read this with the requirement of there earlier, even though I can presume the professional competence of somebody just from the fact that he is a member of the institute, may not necessarily be sufficient. Here, when I evaluate and you say that the other person has been a CA only for 1 year, now you may find that you being a CA with more than 10 years experience, your involvement in guiding the competent auditor may be required more because that competent auditor doesn't have sufficient experience. And therefore, your involvement can therefore have to increase here and not reduce or just rely blindly. Again, that has to get factored. Your evaluation should be in your file. Now, when you start looking at all of this, you find the current SA 600 is not significantly different from the international standard. It's more or less reading the same way. Again, paragraph 19 says there should be sufficient liaison between principal and other auditor. Again, not drawing reference to referral instructions, but if it says there should be good communication and involvement from both sides, this should be a form of communication for this. whatever may be the form, there should be sufficient documentation demonstrating this communication. Again, indicating a need for referral instructions. For this purpose, principal auditor may find it necessary to issue written communication, which means therefore it has to be a written form of referral instructions. Again, principal auditor should advise the other auditor on any matters that come to his attention that he thinks have important bearing on the other auditor's work. Which means if you become aware of any concerned situations existing at the parent being either the head office or the parent entity, depending on how the consolidation is happening, which could have a bearing. Now what does this mean? If I look at it from an SA 315 risk assessment perspective, let's take an example bank. There are various branch auditors, you are the principal auditor of the bank. Now all banks are on core banking systems. Core banking systems are all at the head office. So if somebody has to rely on an IT system, the SA 315 does say you have to carry out an IT audit. Of course, the indices that are proposed to come in have a good do annexures explaining how the IT audit should be done. But even the existing 315, there is a small paragraph which says the IT environment has to be understood and tested. It's just that it did not clarify how it has to be tested, and therefore the revisions to SA 315 happened where they provided detailed explanations, which is also the institute had issued, I think, last year for the discussion and some confirmations from all the members. So if you go through that, you will find that there are two annexures explaining what all you need to do from an IT audit perspective. Now, if those IT systems are maintained at the head office, then only the principal auditor has access to those IT systems. Only the principal auditor can test those IT systems, and therefore, if the principal auditor feels those IT systems are not reliable, because there are errors, problems are there in the system, you may find it necessary to communicate to the component or other auditor saying IT systems are not reliable, therefore do not rely on output of the systems, you have to independently test it. Otherwise what happens, the other auditor may rely on system reports, presuming the core banking system is fine, therefore NPA determination is based on a report drawn from the system, provisions are not adequate, no use. So you may ask them saying no, do not look at system reports, you have to manually look at the documentation maintained at the branch in that client files to confirm whether this is an NPA or not. And therefore there may be further procedures work they may need to do. So that communication has to happen. So anything that the head office may directly be involved in or parent entity may be directly involved in, the confirmation of what work the principal auditor will do and the communication of that to other auditor has to also happen. Now here of course is not a matter of should, but when considered necessary, the principal auditor may require other auditor to answer a detailed questionnaire, which is spoken in the earlier paragraph as well, that sometimes where you are not getting access to work papers or a detailed summary of procedures and findings are not being provided, then you may choose to give a questionnaire. And if you give such a questionnaire, that questionnaire needs to be responded and provided. Now it's a choice. If the other auditor says, yeah, you can look at my work papers and we'll discuss that scenario, I think Rajesh will cover that on how can we go about sharing work papers. Or if they say, okay, I'll give you my audit summary memorandum which covers all the procedures, my conclusions and findings. That is also fine, but if the other auditor says, no, I will not give you either of those two, then you may choose to give the questionnaire. That's the reason it is a may, because you have to look at, start from work paper access, then to detailed procedures and findings. If both are not possible, then you get down to providing a questionnaire. Now you need to ensure that this questionnaire is detailed enough to address all your concerns, your requirements and needs for you to be able to rely on the work of the other auditor. Now please understand, if you have failed to ask sufficient questions in this questionnaire, if you fail to collect sufficient information within the questionnaire, you may be held responsible for not adequately carrying out your responsibilities and found to be negligent as a principal auditor. Which is what, if you look at all the NFRA reports that came out, the fault that they found with the auditor was that they did not actually comply with the requirements. There was nothing to substantiate how did the principal auditor rely on the work of the competent auditor. They did not have any communication. There was no questionnaire issued, fine. Everybody took safeguard of code of ethics and said, I can't share, I will not share the work papers. Okay. So what did the principal auditor do? The standard gives you options. They are not giving you access to work papers. Did you ask at least for an audit summary memorandum? If they said no to audit summary memorandum, Did you give a detailed question? These are the three options the standard said. You have to do one of them. You can't say no to all the three. But nobody had done anything. No, I think as my introduction had said earlier, after finishing close to 25 years in audit, the last 2 years I have been doing a consulting work providing service for quality to audit firms to try and improve on their quality. And in this, I've been interacting with a lot of small size to mid size to slightly larger firms on where they are, the notices they receive from the NFRA, how to respond to those notices. In all these discussions, the impression I got, and unfortunately I think I was also partially at fault before I started this firm also, when we read the standard, we read it with an element of bias. We know what we want to do. Having decided what we want to do, we see if the standard gives us a leeway. We don't do the other way around. We don't go through the standard and see what is it we have to do. Okay? All of them were going with this all, saying, yeah, the other person is a CA, I can rely on his work. That is just one line in SA 600. The line is also very clear that the moment you choose to rely on the work of the other auditor, you have to do all the procedures that are there within the standard. The only exemption you get is some competency. It's not mandated to do a detailed evaluation for the fact that it is a CA. That is the only exception. The entire standard is not exempted. But we read that and chose to exempt the rest of the standard, which is what the NFRA started finding fault with. Saying, yeah, I agree that the person is a CA, but what have you done as principal auditor? Nothing in fact. So the standard is very clear. You have to still do all of this. It's not providing an exemption. Similarly, if you look at, that's again slightly off topic, SA 299 on joint audits. If you read the standard for what it says, the only element of division of responsibility is in maintaining audit work papers. Other than the maintenance of audit work papers, there is no division. But when I spoke to all these firms, they were doing division starting from planning till conclusion. So one firm was doing one part of the balance sheet, when the other part, they have no idea. I said, how can you not? He said, no, that is the other auditor's responsibility. Because we were looking at their file to, they had got some intimation from NFRA, so they wanted us to see their file for responding to that intimation. Their file had only on one side of the financials. He said, what about the other part? He said, no, that the other auditor, joint auditor has done, so we have only so much. Clear case where they're not compliant with the standard. Again, if you go back, we've only looked at the heading saying division of responsibility and total division was done. But under that heading, if you read the paragraphs, in the standard, in the current existing 299, it says both of you will discuss which all account balances have what risks, which means both, or how many of joint auditors are there, will know the risks that are there in all account balances. It also requires all joint auditors should be aware of what audit procedures are being planned to address those risks. All joint auditors should be aware of what is the samples being selected to address those procedures. The only thing they will not have access to is the testing of those samples. That's the only exception. That's the only division. But the testing will be maintained by each joint auditor. The other joint auditor may not look at the testing document. Other than that, everything else is joint, which means everybody has full access to everything. You may not share the work paper, but you're supposed to sit on a table and discuss every element and intimate and inform the other party. But we saw that was not being practiced. And unfortunately, there's not one or two firms not doing it that way. Most of us were not doing it that way. And I realized the difference because when I started my consulting work, we were preparing checklists for compliance. And I actually had to go line by line of each element of the standard. And I realized I also was not complying it fully for the past 20 years, let alone now. But if you start going through the standard for what it is, you'll find it's pretty clear on what needs to be done. And the key difference that is coming out now that we have a regulator looking and overseeing us other than the institute itself, is they are very clear. These are auditing standards, compliance of which is required under the Companies Act. And therefore, this is the law. This is not a guide. So you can't say I exercise professional judgment on which standards I want to apply. No. These standards are referred to in the Companies Act, so this is law. You have no choice whether you will comply with the law or you will not comply with the law. If you have not complied with the law, you will be penalized, which could be whatever, financial penalty, debarring, everything possible. Why? Because you are not complied with law. Now, the key difference for us was, honestly, this was always a guide. When I didn't know what to do, I would refer to the standard. Otherwise, I felt I knew what I have to do. Okay, that I think is a mindset we need to start changing. And this is what when you start looking at SA 600, you'll find even though this has not been updated for more than 2 decades, we are still not compliant with the standard. This is very clear what all you need to do. Okay, so this access to asking for work papers, this is covered. So this is a Code of Ethics underwent a change in 2019, we should have seen, should we have been in line with the standard, otherwise Code of Ethics is not in line with the standard. It could go to that extent. But either way, keeping that aside, there are still other leeways that how communication should have been done, how discussion should have been done, even if work paper access is not provided. The standard is giving those options. Now we've looked at quite a bit on what the principal auditor's roles and responsibilities are. Now what about the component auditor? So when we are looking at the component auditor, again the words I've highlighted here is the word should, which means once the principal auditor has communicated to the component auditor that I intend to rely on your work, the component auditor has responsibilities under the standard which he has to comply. Otherwise, again, he is not compliant with the standard, according not compliant with the Companies Act. Bring to the principal auditor's immediate attention any significant findings requiring to be dealt with at an entity level and adhering to the timetable. Which means if the principal auditor says, I need to comment on consolidated financial statements by 31st May, and in order for me to do that, you will need to close off by at least 20th May. So giving me 10 days to see the impact of your report. You will do your best effort as component auditor to finish the audit by 20th May. You can't say, no, my reporting on this component can happen before September, I will do when I am free. Cannot do. So that means you are not fulfilling your responsibility as component auditor. Again, if you received a questionnaire, which means you have denied access to your work papers, you have denied providing a summary of your procedures and findings, and therefore the principal auditor has shared a detailed questionnaire. The moment that decision has been taken, standard says you have no choice as a component auditor, you should provide responses. And such responses to the questionnaire should be done on a timely basis. You can't do it one day before board meeting, morning of the board meeting. Again, that means when you say on a timely basis, it kind of indirectly again indicates that both the principal auditor and the component auditors have had a discussion where they have both agreed on a specific timeline as to when who will communicate what to whom. And having done that, you should meet those timelines. Again, that's an interpretation we're drawing from this standard, that you should have agreed on certain timelines. Whereas if you go to the international standard, it is actually asking you to agree on timelines. So, as again I say, the difference between the international standard or the indices that we're looking at is only providing you more clarity and guidance on how to comply with all these requirements. It's not changing the requirements. The requirements are already here. Now, these are the only two elements that kind of highlighted saying what the component auditor's responsibility is. Basically, they, again I had this experience with some of the firms when I asked one firm saying, you guys send, and that firm said, yes, we have a practice of sending referral instructions so that we can at least say we've sent it. I said, what do you mean we can say we've sent it? He said, no, sometimes people respond, otherwise most auditors just send the audit report and accounts and we take it. But the problem here is that means the other auditor has conceptually not been in compliance with the standards. And if they are not compliant with the standards, he cannot be stating in his audit report that he is compliant with the auditing standards issued by ICA because he is not compliant. Because the moment an integration is made, the component auditor has an obligation under the auditing standards to communicate, and if he has failed to communicate, he is not compliant with the standards. And therefore the principal auditor then becomes responsible to inform that you're not complied, either you comply or I have to raise concern with the institute disciplinary committee that you're not complying with the auditing standards. But nobody has gone to that extent. Whereas all that is a requirement under the standards itself. So we should be very careful in doing, because here again that means you have become aware of the component auditor's non-compliance, but you have not taken action. And therefore later on if some problem comes in as a principal auditor, you are questioned, you are again found to be negligent. Because you become aware, but you didn't do anything about it. You can't say you are not aware because you sent referral instructions asking for information, other party didn't respond. So it's a clear indication that there is a non-compliance with the standard. There could also be a non-compliance because you sent the instruction without actually discussing with the component auditor. So whereas the first intimation is you have to exercise your intention to rely, thereby giving the component auditor a chance to respond saying no, don't rely on my work. If he says don't rely on my work, there is no use sending referral instruction. Which means principal auditor, as I showed in the first graph, you will have to decide what additional procedures you need to do in order to comply. How can you do procedures? Simple. Companies Act has said you got full access to books of all the components. So you get access to the books, you do your audit. You select your samples, you will do your testing. Only benefit is you don't give a separate report on the standalone numbers of the component. You only factor it in for the purpose of consolidation. And you will have to call it out accordingly, and you not relate on the work of anybody else. And if the component auditor issues his report in advance, you can draw reference to his IFC report or his CARO comments as required. Otherwise, you will say that report is not there, therefore not included in my consolidation numbers. That's it. But you cannot say, okay, I don't know what he is doing, I sent some instructions, he is not replied, but I am taking his audit report as is. Cannot be done. Again here, from a reporting considerations, the principal auditor should consider significant findings. Now again the requirement here is should. Unfortunately, on the current SA 600, the word significant findings is not defined. But that does not mean that all significant findings are modifications in audit report. So just your statement saying audit report was clean and therefore I am okay is not good. I am sure all of you are also aware. You guys also have findings in your audits. Have all your significant findings become qualifications? No. So similarly, the significant findings also may not result in qualifications. So how do you factor? Because the word here is you should consider all the significant findings. So there are two ways. Either A, you have communicated with competent auditor and asked them to share the findings, or under the auditing standards, if you all remember your SA 700 audit report, under the responsibilities of the auditor, and hopefully you guys remember your audit report. One of the key responsibilities of the auditor is that you are communicating with those charged with governance, what is the elements of materiality and all the other significant findings that you had in the course of your audit. That is there under the roles and responsibilities of an auditor, that is referred to in your audit report under SA 700. So principally, component auditor should therefore communicated with those charged with governance of that component. You can, as you have as the parent auditor, access to the component management, ask that management to share that communication with you and make sure you have factored it. So again, you cannot say I have just taken the audit report as is, proceeded, not in compliance. If you are not able to get the finding, you should have written to the management and received the communication. Again, if the component management comes back and says, no, we have no such communication from the auditor at all, you have another problem. Now you have become aware again that the component auditor is not in compliance with the standard. Why? Because in his audit report he has said he has communicated. Component auditor is saying he has not communicated. component management is saying not communicated. Now one of them is telling the truth. So you need to figure out what. You cannot blindly say as a principal auditor that I am just relying. No. So because this element here is again on should, so it's a mandatory responsibility of principal auditor. Another element again here it says may. It says our principal auditor may consider it appropriate to discuss with the other auditor and management of the component these audit findings, other matters affecting the financial information of the component. Now, key factors you need to see here is if this discussion is happening, and because of this discussion, if the component management chooses to post entries, because this is the numbers that has to get considered in the consolidation. It could then impact the component auditor if he has already signed up on the report. Which means the way the standard goes, the component auditor should make sure that this happens before he or she actually signs off the component auditor's report. Because if changes happen, there's a part of subsequent events, what do? You've already given your report, you can't go change your report. Udin is done, everything is done, you signed, physically it's available. You can't go back and start making changes now. And therefore, it becomes the responsibility of the component auditor or the other auditor to make sure this exercise, if the principal auditor intends to come, and therefore again, there should be communication or liaising between both principal and other auditor, providing clarification as to whether this has to happen, and in better interest of the other auditor, he has to make sure the principal auditor has this discussion with the component management and they conclude on the findings. Implications on principal auditor, they may find it necessary whether additional procedures need to be done or not, and if it's not sufficiently done, I think Pramod mentioned that part of the intro, as principal auditor, irrespective of the fact that you have the other auditor's report under Companies Act with you, you will have to evaluate whether you need to modify your report. Why? A, it didn't respond to your referral instructions. They didn't respond or share any findings. Component management may have said, we've already been subject to audit, I've given you the auditor's report, I will not give you anything more. Even if you ask for additional procedures you want to. All of this result in a limitation in scope. Moment is a limitation in scope, depending on the extent of materiality of this component of the consort, you have to evaluate between qualification or this limit. So it cannot be a case that relied on that other guy, he is representing 40% of the overall financials, other than his audit report and accounts, I don't have anything else. That will not do. If you don't have anything else, you have to evaluate modification in the report. You can't just put other matter paragraph and close the rights to it. We already discussed this. Now, I think we just spoke on this. If the work of the audit auditor cannot be used, and why would you conclude that the work cannot be used? Because you have no idea what work they have done. All you have is the final conclusion in the form of an audit report. So logically, as a principal auditor, you cannot, under this standard, claim to have understood what work the competent auditor has done in order to rely on that work. And if you do not know what they have done, you cannot rely. If you cannot rely, you should be modifying your opinion. So when you start looking at how the wordings in the standard are, you will realize that we have not, in true to heart, actually been complying with the standard fully. Because in most cases, and as I said, even when I signed up on console accounts, all we ensured is, do we have the auditor's report from the other auditor? As being in a large firm, we had a practice of issuing referral instructions, we would issue. The other party sometimes acknowledged, the other party sometimes didn't acknowledge. If it was another large firm, they would acknowledge and send those information. Mid-sized, smaller firms didn't even bother. They would only send the audited accounts with their report. Nothing else would come from it. Saying, I have signed my opinion, this is it, please consider this. That is all they would sign. Now, we would accept that and we would go on. But now when I started reading the standard, I actually acknowledged I should not have. That person principally was not in compliance with the standard. I should have raised it to that competent auditor saying, no, you should respond to these requirements. I have sent you instructions, you are now mandated to comply. If not, I should have told the client saying, see, he is not responding. I have to do more work. A, give me more time, give me more fees, I will do the work and I will sign up. Otherwise, I have to qualify. Unfortunately, I didn't do all of that. Now, it's a learning for me also that these are required in this standard already. It's not a matter of, requirement under ISA, but I'm under SA 600, so I'm still okay. No, I was not okay. If the other auditor issues or intends to issue a modified auditor's report, the principal auditor should, before they even issue it, evaluate whether the subject of modification is going to impact them also in some manner or no, or should they carry out more procedures. For example, the component auditor or the other auditor intends to qualify on going concern, significant uncertainty on going concern, that component is just 10% of the consolidated business. So they may have a modification, but you may evaluate and say even if they stop that business, consolidated numbers are not fluctuating too much, and therefore has no impact on consolidation. And though there is a modification in the individual financial of the component, no adjustment may be and no modification is required on the consolidated. But the reason this is coming here saying why this should happen in advance is as a principal auditor, you need time to evaluate the impact of that modification as to whether the modification in the component audit report will impact the consolidated or not. And therefore again, if he gives you the modified report 2 days before the board meeting, morning of the board meeting, saying, now components board meeting is today, tomorrow is the principal company's board meeting. Not done. There should be sufficient time, especially because if the component auditor is planning to bring this element of going concern or any other matter of qualification, both the auditor and management would be aware well in advance this qualification is coming or modification is coming. It's not something that got decided on the date of the board meeting. And therefore they should, again, under this, have a responsibility to communicate it to principal auditor, and principal auditor should evaluate how this will impact his consolidated reporting. Now that being said, there is a small paragraph here also on division of responsibility. I'll put in my thoughts. I'm not going to give any conclusions here on what it should be or how it should be read. Now when I look at SA 200, now again I want to highlight here because there is a reference to SA 200 in SA 600, but that reference is wrong because that reference is to SA 200 that existed in 2002. But SA 200 underwent a change in 2009 and therefore that reference is no longer valid. That's what SA 600 was. But if I look at what the objectives of SA 200 is, very clearly it says that the overall responsibility is that of the engagement partner, whoever, as I said earlier, whoever is signing those consolidated financials, whoever is signing that audit report on consolidated financials. Overall, they are responsible to ensure that those financial statements are providing a true and fair position. Now, how do you get that comfort? How do you ensure that you look at the other auditing standards to compare? But if you are not comfortable with it, you cannot, for all practical purposes, proceed with giving your opinion. Now, under 600, paragraph 24, I don't know if you are able to read that. It says, the principal auditor would not be responsible in respect of the work entrusted to the other auditors, except in circumstances which should have aroused his suspicion about the reliability of the work performed by the other auditor. Now, how do you read this? A, you can say, I'm not responsible, and unfortunately that is where everybody stopped. They just read the first line. It says, principal auditor would not be responsible in respect of work entrusted to other auditors. Unfortunately, there's a comma, but all of us while reading it put a full stop there and stopped it at that. And we are not responsible, I'm just taking his report and done. It's not there. It goes on to say, except somewhere here, arouses suspicions. Which means, again, did you carry out any activity to confirm that there is no reason to suspect? If you have not done any activity additionally to find that there is no reason to suspect, you have not performed your responsibility. You should have carried out those procedures and concluded that there is no reason to suspect, hence you are relying on that work. Otherwise, you have not done it. This is similar to SA 240 on fraud considerations. Everybody reads that one small portion in the standard which says the auditor is not responsible to detect fraud. Again, that sentence doesn't have a full stop. There is a comma. And it goes on to say, provided you have carried out what all is necessary by you as an auditor to ensure that there is no fraud existing. If you have carried out all the procedures and as an outcome of your procedures no fraud was identified, later on a fraud was detected, you are not responsible. But if you did not do those procedures and a fraud was detected, you are fully responsible because you did not do those procedures. Which is again what you can find in a lot of the NFR orders that are in fault. An auditor didn't do their job And auditor is arguing, saying, I'm not responsible to detect fraud. They said, yes, see the standard again. There is no full stop there, there is a comma. There are activities that you are supposed to have done, and if you have done those activities, then you are not responsible to detect. But if you have not done those activities, you are fully responsible. Similarly here again. Only if you have done those activities to ensure there is no reason to suspect, then you can rely on the work of the other auditor. Otherwise you cannot. Now under this, the standard goes ahead to say, and again please pay attention to the words I've highlighted. When the principal auditor has to base his opinion, which means the principal auditor doesn't have a choice, on the financial information of an entity as a whole, relying on the statements and reports of the other auditors, his report should state clearly the division of responsibility. That is, the financial information, how much, and of course all of you are comfortable with the words that we put in the other matters paragraph, saying so much of revenue, so much of profit, so much of cash flows have been audited by another auditor, or are based on management accounts which have not been audited. Now that division of responsibility principally goes with reading the first line. When the principal auditor has to base his opinion. Please understand the terms has to base. But the way I read it is, which means the principal auditor has no other option. If you have an option, then you cannot do the division of responsibility. Now under what circumstances? Again, this is open only for argument. I am not going to, as I said earlier, answer that question because honestly even I don't know the answer to that question. First element is, in case of branch audits, can you call out saying so much were audited by other auditors? My opinion, yes. Why? Because the branch auditors are also appointed by the same shareholders who appointed you as the principal auditor. Because the shareholders have already done such appointment, you have to base your opinion on those branch auditors. And therefore, you calling it out saying so much revenues done by other auditors, so much assets or so much cash flows done by other auditors should be fine. But what happens when it's subsidiaries, joint ventures, associates? You have been appointed by the shareholders to give a report or an opinion on the consolidated numbers. Did the shareholders tell you have to rely on the work of those auditors? They didn't tell you. Why? Because they didn't appoint those auditors, they only appointed you as the auditor. So now, what made you confirm and conclude that you have to base your opinion on the work done by other auditors? Because there is nothing to say you have to, then logically you cannot, there is no division of responsibility, you cannot call it out per se in your report saying this was done by other auditors, I relied on their work, my opinion is not modified in this regard. You cannot say that. Logically speaking, because the standard clearly says only when the principal or auditor has to base his opinion, you will call out the division of responsibility. So this is a kind of slightly open-ended. There is no specific answer to it because, to be honest, the last 2.5 decades that I have been practicing audit, I have been calling it out, irrespective of how that term is. Our general understanding is, see, I am not the auditor of the component, I relied on that component, but the component auditor was appointed by that component shareholders, which are different from the shareholders here. Because if it's 100% subsidiary, then the board members may be the shareholders, representative shareholders there. So logically, these shareholders didn't appoint. So we'll have to be very careful on how in your file you have documented that you have no choice but to rely on the work of the other auditor. And make sure you have sufficient coverage within your documentation on why you've chosen to rely. Otherwise, you will be exposing yourself on having just blindly relied on the work of the other auditor. Okay, with this, I'll be concluding the first session on understanding the standard. We'll take a short tea break, and then my colleague Rajesh will take over the practically how you will implement these aspects, as well as understanding how the NFRS circular would further affect our interpretation of the standard as it stands.
Thank you, sir, for enlightening us with your experience. Listening to you speak, I think it is evident that to be an extraordinary chartered accountant, it is important to perform additional audit procedures wherever necessary. Communication and discussion with the other auditor, the competent auditor, is necessary. And to issue referral instructions without using the word referral instructions is very much necessary. And we should update ourselves on the latest provisions of SAs and ISAs. Thank you, sir. I request the chairman, CA Pramod, to present the memento as a token of gratitude. Dear members, we are about to take a short break to refresh and recharge. We appreciate every small step you take, so kindly be present here post-break for the next incredible session lined up. Thank you. Dear members, we request you to be back here by 10 minutes.
Next slide. Next product next slide. Just next slide.
Only color mic.
ಕೊಡ್ತೀರಿ ಸರ್ ಈಗ ಸ್ಲೈಡ್ ಚೇಂಜರು ಇಲ್ಲ ಓಕೆ
You guys are waiting for a final.
not supposed to wait. Excuse me, can you please stand still?
Over a warm cup of tea. Dear members, welcome back for another interesting and power-packed session. I request CA Rajesh to enlighten us about his insights in audit.
SA 600. This session is a continuation of that, and it's going to cover two aspects. One is the NAFRA circular, the 3rd October circular which came out. And in the light of that NAFRA circular, how do we read what we have to do, and has things changed for us? That's one part of it. And the second aspect is, regardless of the NAFRA circular, as what Jaideep mentioned, how do we go around doing these audits in terms of communication with group management on one side and with other auditors? Right? And other auditors, when I say, it could be a case where you are the principal auditor or you are the competent auditor. So that's really what we will cover. Now we are about 7. The endeavor would be that we do about 40 minutes, because there's going to be a lot of overlap between the prior session and this session. And then maybe we can ask certain questions amongst us, also from the floor. So, the NAFRA circular, what did it actually come up with? And before that, this is just a precursor. Where does it come from? A lot of reviews which NAFRA conducted, especially in group financial statements, consolidated financial statements, and the opinions by auditors. These are all available in the public domain. Some of them are very popular ones. And in all of them, it was found out that the parent auditor probably did not do enough work. And that is where the circular came out, in the manner of a clarification to say, look, SA 600, as what Jaideep has spoken in the earlier session, how do you interpret that? And there are some interpretive guidance which are given, also certain clarifications which have been offered. Now, I also have the NAFRA circular with me. If required, we'll flash that. It's a 12-page circular, 41 points which I mentioned in that, where it talks about manner of doing audits, as well as it talks about certain guidances as SA 200, etc. The primary thing which it brings about in the NAFRA circular is these 5 aspects, which I thought I'll summarize here. Now, by the way, just as before I start, Jaideep mentioned declaration that all the views are personal. But before that, let me give one more aspect. Most of the slides which I have captured here are factual in nature, which is only taking out from the circular and giving it to you. Later on, when we are talking about group management and other auditors, of course, there are certain guidances from experience that I have drawn out. So the initial slides, for example, if you see incorrect interpretation, it's not my interpretation. This is what is the wording exactly in the circular, so I thought I'll clarify that. So NAFRA circular says, across the board as auditors, what we have been doing, incorrect interpretation and selective application leading to insufficient work. Very strong words. But where is this coming from? And that's why I said that we are going to try and connect what Jaideep spoke and what I am trying to infer from the NAFRA circular. The manner in which we have been doing audits, has it changed? And today, as a partner signing some of the listed entities in a large firm, we are all in dilemma to say, has this changed the way we should do audits? Probably the answer is yes and no. It is no largely because SA 600 is what is the framework within which we all are working. That has not changed. Expectation in terms of clarification for listed entities, NAFRA has come up with this circular. But essentially what Jaideep said in SC 600, we all probably have been following. Then where does this incorrect interpretation come from? Is it in terms of performing additional procedures? Is it in terms of professional competency evaluation? Is it in terms of reviewing work paper? Those are the matters which we are going to discuss here. So, where this circular applies to what all scenarios? That's what is captured in this slide. It applies to group financial statements. Is applicable to all entities covered under Rule 3 of NAFRA. Now, Rule 3 of NAFRA very clearly calls out listed entities, unlisted public entities beyond the threshold, and the threshold today as it stands is 1,000 crores of turnover, 500 crores of capital, etc. etc. all of you are. It also includes branches, subsidiaries, associates, etc. No exemption to PSU and banks. This is an interesting one. A lot of debate happened when this circular came out. And of course, it is clear in the circular, but just to call it out, it applies to audits, it applies to reviews also. So to say, oh, should I apply it only in the year-end audit and not to the limited review? The answer is probably no, is what the NAFRA circular clarifies. Because essentially, if you look at 2410, that also draws reference to the same auditing standards, right? So I thought we'll get that out of our way. As I said, there are 4 or 5 aspects that we'll focus on. Professional competency. Assess if the other auditor is a CA, and one point which I have parked there is to say you may have situations where you are the auditor of the parent entity which is listed or is covered under Rule 3. The component and the auditors are either in India, because it's a component in India and hence covered under ICA, or it could also be that the component based outside India. In all of these scenarios, this is applicable. Why? Because ultimate responsibility as a parent auditor, principal auditor, lies with us when we are auditing the parent entity. Right? And that is why there is a subtle difference in terms of evaluation of professional competency. If it's an ICA member, is it sufficient to say you also have a degree, I also have a degree? Maybe no longer, right? And honestly, whether an ICI, NCA, NAFRA, do they need to come and clarify this? Absolutely not. Because today, let us say I am doing an audit of a tea estate, or a real estate, or a hospital. It is only practical to ask the component auditor, say, have you carried out audits of a similar nature? Only then he will be able to identify risks as is expected by me as a principal auditor. Right? So competency evaluation, clearly we all know in our mind that it's not only a matter of, oh, you also have a degree, I also have a degree. Those days are gone past long ago. In 25 years of what we have been practicing, I think, at least in the last 15 years, I can very confidently say we've moved away from that. So then what are we talking about? Skill sets, experience, etc., which is what is mentioned here. Experience and skills, technical proficiency, availability of resources, quality reviews, past performance. Now how do we apply that if it's an ICA member firm? Yeah, okay, has a peer review happened, QRP review happened? Please tell us what is the outcome of that. What is the size of yours? See, let us say I am the principal auditor. Let's take an example. The company's revenue is 10,000 crores, right? The component could be 100 crores. I consider it as material because of qualitative or quantitative aspect. Or it could also be 2,000 crores. Now the pertinent question is, that component auditor knows how to do a real estate audit. Has he handled the size and complexity? To say there are joint development agreements, structured agreements, does he understand those? Because if he doesn't, then it comes back to you to say, no, sufficiency of audit. And that's why it said insufficient work. That is a word which is used in circle. So it will be necessary to not just look at industry, competency of industry, also size and complexity that he is handling.
A combination of all of that will help us determine when a planning exercise is carried out by the component auditor, what is the level of participation that I need to have? Because that is what, as Jaideep was saying, SA 315, risk assessment. Is it the responsibility of only the component auditor? Again, after I clarified, to say no. As a principal auditor, because at the end of the day, we are all working under the framework of SA 200. And that clearly says that an auditor needs to do everything on the basis of which he can say that the risks are mitigated and he is in a position to issue an opinion on the financial statements. It doesn't differentiate there between a principal auditor or a component auditor. An auditor is an auditor. However, when it comes to group financial statements, where everything is getting consolidated, maybe the interpretation then is to say that as principal auditor, you will need to go beyond just relying on asking the component auditor, did you do risk assessment? What are your risks? No. You may probably need to also understand why did you do a risk assessment and identify a particular assertion. Let's take an example. Hospital industry. Everybody is familiar. In India, how does it work? We probably all have insurance in some manner. If you're working in a corporate, through the corporate insurance covers it. Otherwise, we all have individual insurances. And then there are OPD, IPD, right? In a hospital setting. Some of them also offer cashless services. But if you look at overall the industry, the hospital industry and the insurance industries, and these are all available in public domain, you go and see, because we are not only talking about a Bangalore, a Mysore, we are talking about really Heartland. The coverage in terms of penetration of these services is very low in India currently, which means that the people who are able to avail an insurance service on a hospital could be 30%, 35%. And still, if you go to some smaller places, people will be using cash rather than a card, etc. While things have changed after denotification, the cash that I am talking about here is not cash as a currency, but whether I can just flash my insurance to say it is cashless or not. That's the word. Now let's take this example forward. You are the auditor, principal auditor of a company, of a hospital chain, which is listed in India. It has components outside of India. It could be Dubai, it could be US, it could be Europe. Where the prevalent practice could be very different. Where everybody is covered by a health insurance plan. Whether for OPD or IPD, he just flashes his card, he doesn't need to pay anything. Right? This is the scenario we are working with. Now when you do risk assessment, at the parent level for the entity that you are directly auditing, you will say revenue recognition, occurrence is my risk. Right? Whether the service was rendered at that particular point of time, let me verify that. Flip it to the other geography. He may say that boss, cash is never coming to me. Insurance settlement is going to happen 6 months later, 12 months later. I don't know. Apply that in along with Ind AS 115 and Ind AS 109. That auditor may say, no, not just occurrence. For me, accuracy is also important. Because the value at which I will recognize in the financial statements, that could be 100 rupees, or because of deductions in the insurance settlement, it could be 98 rupees. So hence accuracy is also important for me. That is why when you evaluate competency, what is important is you get down to understanding the geography. Same healthcare is done in a very different manner as a service in that geography. And hence your risk assessment is completely different. So now if you say that I am not deeply involved with that component, you may assume that occurrence is a risk. If I look at a consolidated financial statements, I am fine. Whereas this aspect to say that accuracy and these deductions are so important to the financial statements, you will miss out. So competency assessment hence goes beyond understanding what all types of audits he's done, applying that to the geography, and how is he doing risk assessment at a granular level, at the assertion level. As we all know, audits when we do, the risk assessment is not at, oh, revenue, oh, fixed assets, no. It's at that assertion. There are about 14 assertions. I know various firms try to combine it and call it out in a different manner. But essentially it's at that assertion of what can go wrong. So competency assessment hence has to be done. Seeking information from component auditors from a documentation perspective hence means that his ability to decipher data is at that. Right? Please feel free to ask questions. The reason why I'm using a collar mic is, if required, I can come down from this. We are all learning together. It's an interactive session. I observed in the early session there are hardly any questions. Hopefully you're retaining it for us in the later sessions. Please ask questions, only then we can make it interactive. The idea is to take like these practical examples, real estate, healthcare, etc., etc. Right? Now implementing, when do I need to visit component? I think one of the elements which Jaideep had covered. So we spoke about competency, etc. This again is just an extract of certain points which are there in the circular. But however, this is not very different from what is there in SC 600. When you have situations of complex components, significant risks, change in component auditor, these are all there. Let's take an example. Let's take the same example forward, right? Healthcare. Now, in that particular geography, let us say in US, that component went and did an acquisition at the US level. Now, you are auditing the parent in India, US. Now, below that, there is a step subsidiary which has come up because of the acquisition. Now, that means in that particular year, you are in combination considerations. You will have risks coming in both from a controls perspective as well as substantive. And what is the risk? The risk could be on valuation. Right? The risk could also be to say that, is it going to cause a problem in terms of how the consolidated financial statements are going to come out? Because let us say India as well as the US subsidiary is in SAP, whereas the step-down subsidiary now, which has been acquired, is in Oracle. So the combined financial statements or the combined trial balance, how it is going to come up itself is an unknown territory. There could be a risk hence at FRCP, not just at valuation. Right? So all of those situations may warrant you to say, should I go down, visit the component and the component auditor and discuss these out? To say, how do we now plan it out? Because what we have been saying is, oh, GITC is performed at a group level, I will pass on some insights to you. Now that is flipped. There is one more scope which is coming off Oracle. That Oracle server is based somewhere else. Should I audit that? Should I allow the component auditor to audit that? What is the oversight I should have in that? In that IT element? Because the entire information is coming only from there. After that also, eventually what is going to happen is the trial balance which is going to come in Excel is going to be fed into SAP. So that the BPC tool, etc. helps you with a consolidated trial balance. Hence, there are multiple risks that we are talking about here, which we warrant us to say, hey, hold on, let me go down and spend time, forget about the auditor, with that component management to understand how these are being planned. And in addition, obviously, the acquisition date accounting, the acquisition date determination of goodwill, intangibles, etc. Was there enough controls on that? Right. Going on, per paper reviews. Jaideep spoke about it. Where is the issue here? SC 600 says, and I was noting down in the particular paragraph in the NAFTA circular, it says that in more than 20 places, the word should has been used. It's not used shall. And there is I've kept notes so that I can specifically call it out. It says in that particular paragraph of 22, it says that should not confer an arbitrary choice of the auditor to selectively apply the determination of procedures. When you apply that in terms of the what is in scope and how do I look at work papers, the Companies Act does give you the oversight responsibility. I'm very cautious, going slow in terms of the words that I'm using, so that the messages, as I said, from NAFA circular are delivered along with the SA 600. Also, we are able to say that there is probably a difference in the way and the lens through which we look at the world now. Which means that partners like me are really saying, oh, should I be signing financial statements anymore? Right? And why is that? Because the expectation of the regulator today, at least from a NAFRA community, is that the work papers you should review. And that's why the should and shall comes in. However, SA 600 doesn't say the word should for the review of work papers. It says you may. But when you put this together, as I think Jaideep in some place did say that you have to do either of the three. Review the work papers, get enough and sufficient information from the management so that you are able to carry it out, or you go and directly do the audit. One of the three you should do. And especially if it is material. Now materiality again, I'll just digress a little bit to say, how do you determine materiality? Everybody is going to look at it from a lens of a particular aspect. And typically as auditors we work with three parameters, right? Revenue, profits, assets. If it is material from any of these three aspects, and you can define that, it could, you may say 1%, 2% of the consolidated financial statements, 3% of the consolidated, whatever may be the criteria. Firm defined, individual partner defined, etc. etc. Once you have the determination done, I don't think today we are in a situation where there is a choice, the arbitrary choice which is said. To say, should I review it? I think you should use the opportunity to review that. It's a matter of also how do you go about that conversation. You should definitely involve the management to say, impress upon it. It's not a matter of, oh, I'm carrying a gun, if you don't do this, I'm not going to sign. No, I think it's a matter of how do you have that conversation in a polite manner to bring it up to all the stakeholders that, look, there is risks here. At the end of the day, all of us are in this together to protect your risk and my risk. So that when the regulator or any other person who's depending on this financial statement, relying on this financial statement, investing money, he doesn't have to be concerned. Right? That's the overall objective. So reviewing of working papers hence becomes absolutely necessary is what NAFRA's circular says. Any questions so far, because we have covered three aspects. NAFRA circular, as I said, there are 41 points and I have tried to cover essentially three aspects. Where is the applicability, professional competency, do we need to visit, work papers. Any questions so far? Good to move on? Okay. So if this is clear, combining the NAFRA circular as it exists along with SA 600 as it also exists today. In SA 600 it is proposed, it may come up on April 1st, we don't know. But as it exists today, what are the kind of communications that we need to have with group management and other auditors? Both of these legs let's cover. So, just a brief. When I am speaking to the group management, and these are my thoughts, you can add. Now, here onwards, it's all sharing from experience. As I said, in the two parts, the earlier parts were clearly just go back and from the circular. These are all certain experiences that I am sharing. Maybe it is pertinent to say, after having evaluated the competency, after having had the opportunity to understand what is the documentation standards of the other firm, I speak to the management to say, on the basis of the work which the component auditor is performing, will it help me obtain sufficient appropriate audit evidence? If no, what else is required? And it could be two things. Let's go back to that healthcare example. We are testing revenue, occurrence. He is testing occurrence and accuracy. Okay, to test an occurrence and accuracy, what are the attributes he is asking? Right? In my view, as a principal auditor, I am saying I should ask for these 10 attributes. Example. Whereas the component auditor says, I'm going to ask for these 7 attributes. Those 3 differential attributes, if you feel as a principal auditor, is so significant that the judgment to say whether revenue is appropriate, then you should speak to the management to say, look, I am going to speak to the component auditor as well. But those 3 attributes also, you please provide both to me and to the component auditor. Obtaining sufficient audit evidence will go down to that level. Group audit strategy and audit plan. Same example. We'll keep building on this, right? Revenue, and then we said, oh, there is also an acquisition which has happened in a particular geography. The group audit strategy, I determine as a principal auditor to say, I want to visit that component. I want to see the team or the firm which the company has involved for valuation, is it competent enough? How is the component auditor testing what all are the underlines for the valuation? Oh, there are projections. That projections is based on revenue multiples, or is it based on profit multiples? Is there enough sensitivity which is carried out? On that, probably as a group, you should have a strategy so that you can tell the component. The component auditor could have thought through this by his own, but you can't leave it to assumption that he would have thought through. Point number 1 and 2, what does it mean essentially? When will you have this discussion? After you discuss with the management, that's why you need to have referral instructions by whatever name you may call it as. Some kind of a communication with the other auditor, keeping the management in loop to say that if I have to perform this audit, this is the strategy we are working with. This is the information that we need. And there is where we will take a call to say, in addition to whatever work the component auditor is performing, if you want to independently perform certain procedures, that is what this communication is, to say to the group management, to say, look, the component auditor is going to do this, I'm going to review his work in some manner, in terms of what are the audit results he's come up with, but I feel I may want to do certain procedures directly by obtaining the information from you. Once that is in place, the third point onwards, direction, supervision, is on more monitoring exercise, to say I've laid the foundation, set up the framework for the audit. Now interventions which are required, timeliness of those, is what point number 3, point number 4, point number 5 is. Now point number 5, well, the reason why I've kept this is also because many times what happens is, the component auditor comes and says, now this is good, this is a dreams land, but what the component management is paying me as fees is not sufficient for me to put in the necessary resources to engage specialists. You are saying Oracle has come up with that new acquisition. I don't have an IT specialist. If I involve an IT specialist from an external firm, I have to pay something. The fee is not commensurate. A very valid consideration, because it will again lead to insufficient work being performed, which will end up in you deciding whether that's a piece which you need to carve out and take the responsibility to the group. But typically what happens is, after you had this conversation, the most advisable thing to do is to follow it as a conversation with the audit committee. To say, look, we have discussed with the group management, we have also engaged with the component auditor, and this is a summary. The summary is to say that across these entities, hence I am going to get a coverage of whatever, 70%, 80%, 90%. For the remaining, what is my audit strategy? Let us say the coverage that I am getting is at 80%. For the remaining 20%, what are you going to do to give that necessary comfort? Am I going to say that, oh, the 20% I don't know? But at the end of the day, I am signing the opinion on the entire financial statements, entire consolidated financial statements. The reporting consideration to say somebody else has done 10%, somebody else has done 20%, calling out the profit, calling out the revenue in that other matters paragraph is one part of it, which is again kind of pointed out in the officer. Regardless of that, you are taking ownership of the entire financial statements. So that also is a necessary communication today that audit committees and boards have started to expect. To say what are you going to do for the remainder. The other thing also you may want to communicate with the audit committee is to say, having done all this example that we took to say, look, I am considering revenue recognition. Why am I taking revenue recognition? Because that's a fraud risk area also, right? Presumed fraud risk across all audits. I am considering occurrence, but my other component auditor is considering occurrence and accuracy, and hence in the consolidated financial statements, I am going to consider occurrence as well as accuracy. The why of that needs to be told to the audit committee, because at the end of the day, they are also equally responsible for the governance. If they have an input, we should consider that as well. Yeah. Any questions so far? This must be easy that way. So we spoke with the group management, then we also need to speak with the component auditors, right? Communication with the other auditors. All of this clarity of instruction. We said the point 1 and 2 we will capture in some kind of an instruction. So clarity of instructions and expectation. The expectation shouldn't be, give me the report on so and so date. No. When you are performing occurrence as a test, I want you to select population in this manner. In that population, these are the 5 things that I want you to do. The 10 attributes versus that 7 we spoke about. Best case is to call out all those 10 attributes. To say, please test these 10 attributes. Give me the results of these. So that clarity of instructions is necessary. Risk assessment we spoke about. Occurrence, accuracy, get down to that level, speak to them. Timelines, of course, needless to say. Significant finding and issues. Now, the audit starts, let us say, on January 15th. The reporting timeline is February 15th. I speak to him on January 15th. After that, I come and ask 12th February. First, tell me the findings. By then, it's too late, right? The interventions, a weekly call, bi-weekly call, etc. to say, where have you reached in performing the procedures? Are there any findings that we can together address? Because at the end of the day, risk is something we are mitigating together, but at the end of the day, I am the principal auditor. I need to know. So that findings, significant findings and issues, we need to have a communication. Audit procedures. So, I feel as a principal auditor that you should check the valuation standards also. You should check if under those standards, is there a comment by any regulator on the work performed by the valuer? Is something which as a principal auditor I feel. Component auditors say, no, I don't need to do that. I have never done that. Now, this is a specific audit procedure you want it to be done. Why? Because there is an acquisition which is happening in the current year. This is going to be coming and sitting in your balance sheet. If you feel so, then you have to insist to say, boss, please carry out this additional procedure. Use of templates. There is a templates which has been issued by the institute as well, sometime in 2023, I think. Having said so, how to capture information is something which the principal auditor can always direct the component auditor. Say, I want this to be filled up and so on so on. Materiality we spoke about. Now, materiality, there is always a manner of determining materiality. One is to say, I determine it at an overall level and then distribute it to components. Then, I may go and say that certain account balance or class of transaction, I want a different materiality. If so, please discuss it with the component auditor as well. Coordination of work and access to information, I think that's given, as I said, you should also have access to that information as much as what the component auditor has. Resolution of issues and review, timeliness is important. Component auditors, independence and ethics. Now we all work with an independence framework. In India, this is a listed entity. We are covered with a very different independence consideration. In US, that component, let us say, is a private enterprise. So he is saying that I am only carrying on the valuation exercise. Are you okay with that? If you are not okay, then you need to tell him that this is impairing the independence. You cannot carry that out. And if that means that he's going to lose business and he needs to compensate it, is a conversation you should help him have. Because otherwise, without that independence, the objectivity of the audit will be vitiated. Technology and tools we spoke about. One is the aspect in terms of the company's financial statements, SAP, Oracle, which we use. Second is if you are using certain tools and methodology to say how do I determine an MUS sample, he doesn't have that capability. Then do you want to share those manner of selection of samples or manner of doing analytical reviews? Do you want to share that? Then you should have that conversation. Local and regulatory requirement, absolutely important, because as I said, the insurance example was for that. So you need to have a clear understanding of it and give them, help him come up with that view. Sometimes what we also do in many of these cases to apply SA 600 appropriately is to involve specialists from that geography independently. So there is a component auditor. He says that this is how the insurance works in that geography, but how do you corroborate that before relying on that information? So you may want to involve an expert to say, generally what is the timeline within which an insurance settlement happens, what is that percentage of settlement? Why is that important? That is because we said accuracy as an assertion. It may help you determine whether that net off of 2 rupees, is there an adjustment to revenue or is there a 109 adjustment? Is it a time value of money or is there an adjustment to revenue? So all of that consideration comes. Good so far, any questions? Okay. Let's do a quick knowledge check. Should component auditor's work paper be retained in the group auditor's audit file? So as we said, let us assume we are the group auditors. Jaideep is the component auditor. We have asked all these questions, instructions, we said. We reviewed his work paper. For whatever reason, he was very comfortable sharing his work paper with me. Should I retain his work paper? That's the question. Any answers, please? No? Yes? Can I have reasons also along with your saying? To demonstrate sufficiency of work, you feel the work paper should be retained in the group audit file. Is that what you're saying? Yes. Okay. Any other responses, please? Is there a mic which we can pass on for people to... Sir, you wanted to answer something? Yes.
It's sufficient if we make summaries and extract and demonstrate in adequate detail what did we review and how did we conclude on adequacy and the takeaway therefrom. We don't need the component auditors work with us.
Okay. Any other views? There's one view of no and the reason. The reason could be different, you know, the answer is the same. So the requirement obviously is not to have, as my colleague here Sir mentioned, the requirement is not to have the work papers of the component in your file because it may actually add to more risks. What is required is how was the audit planned. This is what we said at the time of planning exercise under 315 they are getting engaged. What are the procedures that he performed and what are the results that is obtained. If that is summarized, that should be sufficient. One more knowledge check. Should group auditors communicate with the component auditor on the conclusions reached by the group auditor on the components? So let's take this example. We said there is an acquisition, right? In the geography, so we are India, US, below that there is an acquisition which is happening. For whatever reason, the sensitivity which is used in the valuation, you felt that there is an adjustment which is required, and hence there is a conclusion which you derived which is slightly different from a numeric perspective. Overall conclusion whether it's material is not the point, but from an adjustment perspective, you feel there is a little bit of adjustment which is required at the group level. So you went and discussed that with the group management. So now, given that as an example, the question here is, should group auditor communicate with the component auditor on the conclusion reached by the group auditor on the component? I took a position, he has given me a deliverable, he signed and given me. But I am taking a view which is slightly different from whatever view he has signed off.
If it's part of the same network or affiliate, important to do so.
That's a very interesting answer. So there are two scenarios possible. Say I am part of a particular A firm and I have a member firm which is sitting in US. So then I will probably, you're saying yes. If it is not, then I don't care. Is that what you're saying?
If I'm opining on the group financial statements,
I am.
yeah, so I don't think we should reach out to component from our conclusions.
Any other answers? This is really the crux of the how we understand this. And that's why I would like to get a little bit more views. I know it's 7:30, everybody wants to go out. Whatever views comes, whatever comes to your mind, please.
It is important we speak to the group management and leave it for the group management to thereafter cascade it down to the component if they think it is necessary.
So there are four parties here: group auditor, group management, component auditor. The component auditor has given a clearance along with how he performed. He has given that to me. I went and said I need to do some iterations in that in the group financial statements. I discussed that with the group management. Now the component and the component auditor, should they know by my communication with the component auditor? That's the question, just to reiterate. We have one view, of course, to say not really required. If it is the same part of your affiliate, then maybe out of courtesy you are saying I will. Okay? Any other views?
It's required.
Is it required?
It's not required.
Is it required? Okay.
Might be that on the basis of that adjustment or something like that, component auditor may change his opinion on standard financial statements also. Might be in fact that also.
Yeah, that's a view to consider. To say that there is a possibility that he may want to change his opinion. Second possibility is also, see, this is a continuing engagement, right? Today he has given this view. Next time, what does he need to do? You don't need to wait for the next planning meeting, next reference instruction. Maybe he is aware, and if you share that perspective, then he sees light, or he says that, look, I am okay with whatever opinion I have given. Because I am looking at this component as a standalone. Could also be a view, right? He may take a view after the communication in a different manner. But probably, while this is not a matter which is covered under SA 600 in ink, to say you should do this. There's more of a question to say, in a practical experience when you're dealing with these situations, what do you do? So practical experience, the best case scenario would be you please communicate to him. It is not necessary he may go ahead and change. It's probably lying beyond just courtesy. And sir, I think, at least in my experience, if I may share, even if it's not the same member firm that I am part of, we usually share because it helps me to mitigate my risk to say that, look, next time is one aspect. Second is, if it's an adjustment, right? And today, if it's an adjustment entry, corrected misstatement is how you are considering from a consolidated financial statements. Do you need to push down that entry into the component? Goes back to the materiality and the threshold that you determine, and hence it may be necessary.
I think the only thing we should be careful is we have come across something as a group auditor and the privy to that information is not with the component auditor.
That absolutely is correct. If that you have information which is additional which the component auditor is in, then you should probably make sure that the component auditor is also privy to some of these information so that his judgment is applied including the information that you are privy to. Yeah? Okay, so this is more of a summary in terms of insights. We have probably discussed all of this. Between principal auditor and component auditor, hence what is necessary is adequate coordination. Completeness of components. Sometimes what happens, there are 80 components. And there are companies, right? They say, I'm trading like some tomatoes and potatoes. Some companies I bought, some companies I sold. So in consolidation, there are some entities which are missed out. So the completeness of components is one aspect. Very critical, and I have not had a situation where something is missed out, but that complexity in determining those, as well as to determine that is it a subsidiary, is it an associate. Those are very important considerations because even when you send instructions, if you erroneously say, oh, this is an equity pickup, and hence the procedures that I'm going to do is A, whereas that itself is a judgment that it could be a subsidiary and hence the procedures that you perform will be very different. Similarly, assessing unaudited components. There will be situations, as I said, you go to the audit committee and say, across me and my component auditor, I am covering 95%. 5% is not audited. That unaudited component, is there any residual risk? How will you cover that? Important for you, not just for the audit committee alone, but important for you also. So, how did you assess that? Avoid mere reliance on component auditor despite significant risk. As you rightly said, if there is any additional information that you are privy to, that's why you are not saying that I will rely only on the opinion that is given. Evaluating fraud risk in components. That same example of that healthcare, insurance, all there in public domain also some of it. You notice that there is a huge residual because in that geography the insurance company settles 12 months lag is there. India generally the insurance company settles in 2 months, 3 months. There it is 12 months lag. So now think of expected credit loss, etc. Now you are getting information that was that insurance company was to pay you has become bankrupt. Did the component know? Because in the geography you get sensors, right? To say, oh, this is where that particular company is heading, insurance company is heading towards. And hence, was there any fraud risk that you need to identify? On the revenue recognition in the first place, 12 months ago when it was recognized. Those all kind of considerations will start coming up now. Identifying understatement of related party. Related party, obviously, see if you look at, especially the NAFRA circular, across all the cases they have found that related party transactions and the manner in which audits have been performed transactions have been very, very weak. So that's a particular focus area. Validating the appointment of branch auditors. See, branch auditor, I think Jaideep also covered, very important aspect to say how that is going to come in sitting a standalone financial system, right? Because it's a part of standard. Validating group-wide internal controls. We spoke about that SAP, Oracle, etc. Internal controls coming from IT as well as otherwise. Evaluating non-consolidation of subsidiaries. The judgment to say associate equity pickup as a subsidiary. That's this. Sufficiency of participation. Say, should I visit them? Should I? Which? So there are 3 components. I say 2 of them I will review work papers, 1 I will not. Why did you use that judgment? I think that's a very important consideration to document. Okay. So, reporting considerations now. There are 2 scenarios possible, right? I am the parent auditor, I am the component auditor also. So when I am the parent auditor, then what happens? And I am the component auditor also, then other matters paragraph, should it come or not, is the question. Should not, no, because I am the same firm. It's not a different firm in a different geography. Same firm. I am doing the parent, I am doing the subsidiary. I am covering it, no? Then why other matters paragraph? That's what is the differentiation which we are calling out. Other one is obviously self-explanatory. Now, the last one which is in bold is a very important one. Applicable for domestic as well as foreign companies. To be read very carefully. Why? Because you have to work within the framework of ICAI regulations. If it's the same firm which is auditing the company which is outside and you are issuing document, that's a different matter. If it's a member firm, it will still come under other matters paragraph. I am firm X, I am auditing A which is in India as well as B which is outside India for consolidation purpose, not issuing a standard copy. Maybe other matters paragraph not. I am X, I am auditing only A. B, I am not auditing. My associate firm X1 is auditing. Other matters. That's the differentiation here. Right? Okay, so this is just my concluding slide. The ultimate responsibility is with the group auditor. That is needless to say. Ensure adequate participation. There is, in the era in which we are, if you feel 5 more things I need to do, please go ahead and do it. There's nothing stopping you. Effective and continuous communication. That's why I said, oh, today I send the instruction, I sit on it for 1 month, later on I leave it. No. Very, very consistent, regular interventions, set up calls, set up Teams calls, etc. etc. Scope components based on significance and professional judgment. So there could be a situation where, let us say, this acquisition which has happened is in a particular geography which you ignored so far. But just because there is an acquisition happening in that year, at least you may want to scope it in for the direct reviews that you want to do. And otherwise it goes back to the normal to say, okay, let's not review and do, I may not want to review the work because etc. And then as the golden words are to say work not documented, not done. So documentation. Right. So thank you so much. We are happy to take questions, but my understanding is there is one more session that we have, which is we are amongst each other going to ask certain questions and see if we can answer that. No, both of us can say. Do you want to take a mic there? This mic?
I asked the question, we may have a mic there.
Okay, sure.
So we just have a few questions that I have for Rajesh that I had picked up, and after which of course we open for any questions you guys may have. Now I think indirectly Rajesh did answer this kind of a question, but with NFRA overseeing audits significantly for public interest entities, would this circular or their interpretation of SA 600 therefore apply only to listed entities? Or consider the fact that it is an interpretation of an existing standard, would this apply for all group audits, whether public interest entities or private entities? So, what is your thoughts?
So, see, the NAFRA circular today obviously is kind of called out that it is mandated to apply this for entities which are covered under Rule 3 of NAFRA Rules 2018, which obviously we know the definition. However, in practical experience, it is very difficult to. This is like saying that if I am driving a car in the Bangalore roads, the rules applicable to say I stop at a signal when it is red. And if I am driving the car in Mandya, red means I need to go. Can't be the case. So applicability in terms of how I apply SA 600, I don't think will change. NAFRA today has said that please ensure it is done for me, my entities which are covered under me. There is guidance required here, and which is where I think ICAI has also been discussing. These kind of sessions are probably helping people to capture the insights collectively from all of us as members to say, what do we do in this scenario and take this forward. Because at the end of the day, one way to look at it is very good. Today we have ICAI, NAFRA, MCA, everybody has an oversight of this area. That's one way of looking at it. Right? So hence we can't go wrong. So 3 people are going to come and ask you this question. But is there consistency is one more way to look at it. As a professional, as a young professional today, let's say who's coming into the into chartered accountancy, he'll be highly confused. So this is a set of rules. If you're driving the car in Bangalore, if you're driving the car in Monday, that is different. No. If you're driving in US, I can understand. If they're right, left, etc. But otherwise, it has to be consistent within India. Would be one way. Jaideep, of course, if you have any other views, you can
I
add.
agree with that, and I think you kind of answered this question also as to whether it applies only for annual audits or do we have to apply for.
Clearly, for every situation where, in the capacity as a chartered accountant of a statutory auditor, I need to give an opinion. In all of those scenarios, it will be applicable.
You might have kind of covered this, but this type of question is coming more because of a lot of concerns, in the various seminars that people have raised. Saying the circular kind of gave an impression work paper reviews are mandated, but the people cannot share their work papers. Now, from a circular's interpretation, do you feel people having to share work papers is now mandatory? Because a lot of concern was raised between is this in conflict with code of conduct, should we do, can it be mandated? The circular is saying the code of ethics is, perhaps should have required a revision because Companies Act mandates it. A lot of interpretation issues aside. But considering the fact that this is the regulator who will look at my work as an auditor, do you think it's mandated that I have to review a component audit? If I'm a component auditor, is it mandatory now that I have to actually share my work papers? Or, the standard gives me other ways to also do things.
Absolutely. So I think if you look at it as a summary for SA 600, what it clearly says is you need to make sure the objective, as I said, under SA 200, which is to say that have I performed enough procedures, mitigated enough risks for me to give an opinion on the financial statements, the group financial statements. If there is a component and that is material, one way to do that is to say I will obtain the work papers, review them, etc. There are obviously alternative procedures which are possible. Ultimately, we should meet the objective to say that group financial statements, however, make sure that I have covered all of it. So the answer would be that it doesn't say it's mandatory. It is the best practice to say you will. Otherwise, what is going to happen? Jaideep is an important auditor and the principal auditor. He has also done that work. I will also go and do that work again. To avoid that situation, it is probably better that we coordinate amongst ourselves.
And just to add to that, if you read the way SA 600 is drafted, in the event a component auditor is not willing to share work papers, as principal auditor, you can provide a detailed questionnaire asking for a lot of information. And the moment you choose that, the standard mandates component auditor also to respond to that question. So that's another way for you to collect information.
Which is
At the end of the day, it is to
cover.
satisfy your concern as parent principal auditor that everything that needs to be done has been done. How you do it is
Questionnaire is something which probably you may want to cover as part of the instructions if you may feel so.
Okay, now this is just opened up because most of these other seminars that I've been to, everybody keeps especially around tea break, lunch break, this topic keeps coming up. A, this will result in increased work for component auditors, no change in fee. On B, this is more for the benefit of the large four. Chances are there will be a change in the component auditor where the principal auditor will take over the audit of component. Therefore, loss of business. I've been out of practice for about a little more than a year now. So, as a practicing CA yourself, do you think this is a risk or a new business opportunity?
Yeah. So there are two parts to the question that you've asked. One is to say, does it result in more work? I think we, as all of us as professionals, clearly, whether you call NAFRA as a regulator, whether you call MCA, some QRB reviews, etc., ICI has its own review mechanism. I think objectively, if you look at it, every regulator is going to come and ask sufficiency of work performed. From that perspective, do we need to change? Because if you recently QRB came out with a report, right? Even there, one of the reports we were recently discussing in the earlier session, they have said 100%, I'm reiterating, 100% of the samples selected for QRB, risk assessment was not performed appropriately. It's there in the public domain. QRB. But what does it mean that every regulator who's going to review work is going to come and ask the same question to say, did you do enough work before you conclude on the group financial statements? So from that perspective, probably there is a need for us to look at the same subject matter through a different lens. SA 600 has remained the same. In SA 600 when it comes, that's a different matter. SA 600 has remained the same. Maybe the documentation of how we do that work has to enhance. I am clearly of the view that more than the risk, it's a huge opportunity for all of us as members, because opportunity in terms of enhancing skills, opportunity in terms of networking amongst ourselves, to say that today I am a firm of 2 partners, there is one more firm which has 3 partners, can we work together and demonstrate to the client to say that look, we have expertise amongst ourselves and hence we should continue this audit rather than giving this component also to the large firm is an opportunity, is how I would see it.
Additionally, I think one aspect from having been in a large firm earlier, it's not easy for a large firm to say I will take over the audit of the component, because no component will pay the fee that the large firm needs. Okay, it will be easier to pay more fee to the current component auditor rather than pay the fee to the principal auditor, because their fee will be far higher. So it's not necessary there will be a loss, but the coordination required between the other auditor and the principal auditor, if that improves, I don't think there will be any scenario where a forceful change would occur. If the component auditor or the other auditor says, no, I will not share anything, I will not reply to instructions, I will not give you any access, nothing will be done, I will only give you my audit report, then yes. Because that clearly is a non-compliance with SA 600 by the component auditor themselves. That may involve the management deciding to change the audit. That is because of non-compliance by the other auditor. As long as the other auditor is complying with the standard and providing all the support necessary, I don't think this is going to result in a loss of or a change in auditors as currently being perceived.
Yeah. And at the end of the day, as when we look at SA 600, certain paragraphs, para 9, para 10, etc., what Jaideep called out, and what I have also been saying, auditor is auditor. It doesn't differentiate between a principal auditor and component auditor. If overall the objective is that this financial statement has gone through risk assessment and a mitigation jointly together, that is the overall framework we are working with.
With that, I'll just put up and open out. Any other questions anybody has?
Sir, good evening. Hi,
Yeah.
I am Deepak Mahindakar, practicing chartered accountant. I just wanted to check out all these facts. Audit of the listed entity, which is a bank, for example. A stat auditor or a principal auditor has completed his work, given a report. The same job is done by the regulator. Same job is done by the regulator as well, under a different section, and the report is given. Nothing untoward is seen in these reports, but still this listed entity goes fucked at the end of the day. The listed entities employee who has done this job, assume he's a chartered accountant, member of the Institute of Chartered Accountant. Now, as far as accountability is concerned, how do I take the accountability of the principal auditor who was appointed at the regular members, and the regulator who has appointed the CA, who is his own employee, RBI's own employee, for example? What is your view on this? How would it stand at the institute's level, and how would it stand at the courts? Thank you.
On the courts, how it would go?
First at the institute's level, sir. Let us
I
understand.
think we'll speak from an institute point of view, because legal is a very different domain than of us are.
See, prospectively, if something was found to have happened, so 2 events come into play. A, if it is a clear case of an event that took place post-audit having been done, which resulted in the bank.
Sir, post pre-audit, let us not worry, sir. Let us worry about there is something wrong with the listed. Let us worry about there is something already wrong with the
Listed entity, okay. Neither the stat auditor was able to point it out,
Let us-
nor the regulator was able to point it out. Let us start
For
talking
example,
from that.
the entire conversation, because again, I can draw references being in public domain, ILFS. An auditor has signed off on 1 year, the auditor signed off on the next year, the auditor changed, the new auditor signed off 1 year. Then during the half year, there were concerns on repayment of bank. So the event that triggered a problem happened in the second year of the new auditor. But if you look at what has happened, they said the very fact that operationally where the loan was given to another party, that happened 4 years ago, where the earlier auditor was auditing, and that's how the regulator has taken the effect. Now the question whole thing comes in is, what was the event which triggered the so-called problem that you are raising? The event that triggered, was that event something that, unfortunately that was perhaps at hindsight, but otherwise, was that an event that could have been identified? Both, now the regulator may get reviewed separately because one regulator will not go behind another regulator. So the fact that the regulator's review did not also identify it will not get questioned. Okay, so from the
event was all pervasive. It was there. Let us take an example of a bank itself. Okay. We know the separation of NPAs in banks. We know the separation of NPAs. We all know as chartered accountants the separation of NPAs in banks. Okay. Where this is ballooned to an extent where the reported NPAs, let us say 4%, whereas the actual NPAs say 20-30%. Okay. And the appointed principal auditor has failed to bring this fact, nor the member of the institute who is an employee of the regulator. This is what I am stressing. I am underlining this point. The employee of the regulator who is the member of the institute as well. And I ask you for the specific opinion of the institute on this. Not the
reference you are drawing more is not from an auditing standards perspective, but more from a no-class perspective and code of ethics.
Accountability, yes.
It is accountability, this will come under code of ethics.
Let us put it.
Okay, because code of ethics applies both to a CA in profession as well as CA under employee. Okay, there are two separate chapters covering both of them. Now under that, if there is an element of no-class and both that person, I am not talking about negligence in the review that they carried out. But in the review they carried out, they became aware of this inconsistency in the basis of FTA administration or identification. Being aware, still ignored it. Then a problem comes.
Is this a grey area as of now?
It is a grey area.
It is a grey area.
Because I need to be able to prove that you were aware of that inconsistency. Pre-existing is another matter.
See, determining whether there was pre-existing, first that is you have to go through the process. Second, at the end of the day, the conclusion also, as you rightly said, could be clear because there is code of ethics, NOCLA, disciplinary committees of ICI, etc. Determining whether this is negligence or is it gross negligence plus intentional. To say I was privy to certain information which I did not consume in the manner which I should have is what will come now.
So the grey area is not knowing the intention behind or the basis in which the approach was taken. Problem is if that situation happens now. Okay. Whether it's a regulator looking at it, and the regulator being, as you said, NFRA, MCA or ICA, because all of them are regulators, will depend on did that implication arise from inadequate work from the auditor. Now whether that auditor, as from a code of ethics perspective, I may look at that CA separately, the auditor separately. If I look at from an auditor's perspective, unfortunately 99% chance I will look at it from the benefit of hindsight. I know for a fact it has gone wrong. Having known it has gone wrong, is it possible for you to be having privy to it at that point in time? And therefore, like a lot of the questions that we asked, did you demonstrate sufficient professional skepticism when the client gave you that NPA is 4%? How did you demonstrate such skepticism? What were the additional procedures or procedures you carried out to confirm 4% was appropriate? If it is determined that the procedures you carried were inadequate, then they'll say you did it intentionally, you probably were aware it was 20 or 30%, you have therefore not carried out such procedures, you relied on whatever management has given you and accepted 4%, you were grossly negligent. Because I have the benefit of hindsight to say right now it is at 30%.
And you know, this may
Okay,
not
so the
necessarily-
grey area is the absence of your approach, the extent of documentation in the file, and everything else around it. So in that absence, I can't give you a direct answer as to what the implication is.
Coming to the direct answer, as you said.
No, the idea
No,
is
because
that
the
this
questions
gray
have a lot of gray
areas
areas.
could also come out in information sufficiency, procedures being carried out whether they were sufficient, then comes again negligence, gross negligence, etc. The moment you are able to conclude in any of them, then we will see whether the judgment which that auditor applied, at 4%, 12%, whatever you mentioned, was that appropriate. After that, it is no longer a grey area, once you are able to determine that. So hence it may not be a straight answer when we look at all of these together. An interesting question. Any other questions that you have?
Sir, having the timelines unchanged, will it be critical to perform all these processes?
See, you know,
I only put it this way, there is no mandate within any of the auditing standards or regulations which says that you have to commence your audit procedures only after 31st March.
see, if you need more time, you just need to start the work early.
Yeah.
And that's why I had two slides, right? One is the communication that you will have with group management, and the next is communication that you will have with the other auditors. Before even having that other auditors conversation, you probably need to have the conversation with the group management and component management to say that I think in this scenario where there's an acquisition happening, etc. in this example that we told, if I need 2 more weeks, and when I say I need 2 more weeks, it's not me, the component auditor needs 2 more weeks. Let's start the audit 2 more weeks and agree on that timeline with the component management.
So to give you an example, like how I used to do in the past, finish Q2 by October, November, December, I'm visiting the component managements, having conversations with them. January, as we start Q3, I'm having meetings with the group management, giving feedback on the information from component management and what are the key areas to be done. February, I'm having discussions with all the component auditors. Okay, on what needs to be done, how it needs to be done, what are they doing, what will they report to me, what will they not report to me, what format will they report, depending on get an agreement on all the formats. By mid-February, their instructions, you call it reference instructions or whatever, the written form goes out. Mid to end February. So it's all done well before March, and what all these aspects need to be done. After that, it's, I should keep one member whose job was only to follow up with all the various component auditors to say when are they sending, what are they sending, what is happening, is the timelines in line, are you getting delayed? One person in charge of that.
Okay, I think the key thing is not on timeline. I think timeline, if you need more time, that's fine. And one of the things which I had consciously put was fee, which is the most very mildly spoken thing. If together as an auditor fraternity, if we feel that we need more money in the table so that we are able to engage better people, better technology, we need to voice that out, because that is probably the number one factor because of which our audit quality is getting such a way.
Who will voice it out?
I put it this way.
So we in the
Correct.
who is
Once
we?
appointed, minimum 5 years they can't change you. So you need this fee.
No, the best part is we all talk about we, but who is that we is something which
We
are
are
not
all
aware
those
of.
professionals who decided to put the caps of auditors.
Individually, each of us, if we do our job, which is to say we speak to the manager. See, the problem is today, I feel, for an example, I feel to do this audit I need 40 lakhs. If we all stand together, say if we come that management says 40 lakhs is too high, let me go to Jaideep. Jaideep is ready to go at 15 lakhs. That is where the problem is. If Jaideep and I speak as a boss, 40 lakhs is the rack rate for this audit, then the management doesn't have any option.
Correct, the rack rate, so therefore the rack rate should be set by a regulatory body which set the rack rate. Because as an individual, basically what happens is that there are different types of firms. different type of people. Some want money, some do not want money. There are different type of people. Some has a passion and then do that. Now, as simple as that, last week we were working, getting on assignment, and then they wanted us to do some work. They wanted a certificate. We said, we can do it, we need time, and this is the cost. So then what they immediately told us, okay, I think, but this is an urgency, you please resign, we'll get it done. Now the challenge is that other person is willing to do it. Now every profession has some people who would be there, we can't control them. So we can't control them. When all the management, what is their requirement? Are they looking at, are there any value that is coming in? See, there are again multiple type of companies. There are very large companies where public are the stakeholders.
Right.
And there are companies where the public is really not a stakeholder, but it's pretty large. There are some companies which is not small, but pretty big. But even there you need to do that. So there's a uniform standard that is there, the current standards and uniform irrespective of whether really a public stakeholder is there or not. And if you look at it, there was a government, there was a thought process to not to have audit for small companies. Remember they had that. The amount of hangama that people created, that we should have it because we as auditors are going to do so. That means we have not understood that we still want audit of everybody.
No, but sir, that is changing because the risks have increased in audit now, right? So, one way to look at it is all of what is coming out, changes in auditing standards, the way any regulator is looking at, international regulators, India there are multiple regulators, all of them are looking at audit quality. At the end of the day, that is what we are talking about. Once there is a consistency in the quality, whether I do the audit, you do the audit, that's the same expectation which will come up. And the same delivery also which will come up, then there will be a situation that you want 40 lakhs, I may be able to go with 30 lakhs. That may be because, that could be because you have a resource who's 10 years experience, I feel I can do it with a 5-year experience also, maybe that is the reason. But it can't be 40 lakhs and 10
5 lakhs. That's where
5 lakhs. That I think slowly only things will change, sir. I don't know whether a regulator will step into it because regulator will say that I'll give you guidance. If I start coming and dictating, then the next step will say, you only appoint auditors, why should the companies appoint?
But if it's a slow process, by that time the profession is already gone. It cannot go through, we
That
don't
is why
have time
stringent
for
rules
that
are
kind of a slow process.
So this conversation is something I've been explaining to for the last 1.5 years. Okay, ever since the NFRA's order started coming out, everybody's concerned saying, if you want me to do all this, but he has to go up. NFRA said, I agree, if he has to go up. He said, I don't know why you guys are doing audit at such low fee, you guys have to increase. It's not possible for auditors to be charging this low fee. Now the question came as, so who's going to increase the fees? NFRA said, that's not my role. Okay, I can make an observation, it is low. It is, end of the day, you guys are the professionals, it's a profession. You guys are self-regulated in that respect. You guys decide how and what you want to do. Now when they say you guys, does it mean you as an individual? Does it mean you as a member of ICA or ICA by itself as a body? They say you figure it out.
They give a minimum fee, they say, but it is not mandatory.
No, so that's left to
doesn't even want to.
Now our institute has to come up with a plan.
They don't have the guts to say this is mandatory. They are what they want.
I don't know.
In front of Nafra, there is the same question for the Nafra chairman last time when we had this meeting. So what they said is, as a profession, you have to get up there. I can't help you on that. That's left to you as a profession. So I think this should go on a different debate
I think
rather than this.
the next council when they have to should be the central council members and ask this question.
All this for me, it is theory, knowledge. If the fees goes up, I'm ready to work upon being audit. Otherwise, I may not even do that audit.
Exactly what the regulator is also
work
saying.
out for anybody. Forget about me.
There's a YouTube video.
Valid point. There's no doubt about that. Valid
No
point.
theoretical.
The only thing is today I will clear up for any regulator. If you are saying that because of fee considerations, at least my documentation is not reflecting as much what I have performed before issuing the opinion. And I am only exposing the risk to myself. And at that point of time, as an ICA body, NAFRA, etc., nobody is going to come and save you because you as an individual have signed that. I think whatever we need to do individually to make sure our membership is not in a threat, we should do.
So if you look at that NFRA seminar that happened, where they had called all global regulators, I think PCOB, FRC members were all there, independent directors were there, and there was a panel with a lot of auditors coming in as participants. In that, the NFRA chair gave an example also. Where he said there was one engagement where the auditors have charged, I think, about 1 or 2 crores as audit fee for local reporting. Same entity is listed in the US. So they've done the same financial numbers haven't changed because India's IFRS numbers are not any different. They've issued the form 10K, whatever that needs to be filed there. Fees are 7 or 8 crores. So I said, tell me what's the difference between the accounting standard? What are the difference between the auditing standards? That for the India reporting you did it for 1 crore and for US reporting you charge 8 crores. So logically India reporting should have been 8 crores. How did you guys manage to do the audit in 1 crore? I don't know. Unless you are saying the audit quality for that is here, audit quality for India reporting is here, and that's how he brought it out as an example. He's saying overall the fees that the auditors are charging is very low. I have no idea how you guys are maintaining audit quality with those fees. He's made an opposite, which means any file they pick up from an investigation, we know is in trouble because with those fees none of us can maintain.
During we have to pay, they don't pick it up. That's all.
Yeah, that's draw of luck.
That's all.
No, so they have given this feedback as a profession. Unfortunately, we are not auditors. If we get all together, this will get
So when you
fixed.
say we, the we is us because we all have to stand up together on this.
As I just mentioned earlier, everybody agrees 40 lakhs fees, automatic client will. If you said 10,000 for the certificate, and everybody says, yeah, it's 10,000 for the certificate, automatically he will not ask you to resign.
Sir, today I'll tell you, Jaideep has stepped out of the role of signing. I am already contemplating because the risks are high. Reason for that is this one. Say somebody else is ready to sign at a lower fee. Hence I am under pressure to keep it the same fee or lower, but the risks are increased. So why should I sign a If we are all not together, I might also mitigate my risk in these procedures.
Can I come in here? Sorry.
Sure, please.
Okay, I just have a very interesting case which came up last week. This was a public sector company which called CA firms to come and assist them in preparation of financial statements for the financial year.
Thank you, sir. From points to discuss with the group management and other auditors to striking a right balance between quality and quantity of audit evidence with beautiful, relatable examples and interactive questions, you have enriched us with many practical insights to take home today. Thank you, sir. I request CA Pramod to present a memento to CA Rajesh as a token of gratitude.
Picture for a new This is what was the interest in knowledge that I'm here. So,
As we come close to the close of the session, I would like to take a moment to express our heartfelt gratitude to our distinguished speakers who have shared their wisdom with us. We would also like to thank Bengaluru branch of SARC for organizing such an informative session. Thank you.
thank you.